A very good morning, friends. So we were talking in terms of financial instruments with you, and I hope that you have also watched the three classes initially. And I guess you have also made your good revision in terms of things as well. Well, we started off the journey in terms of Index 32, and we are now talking in terms of compound financial instruments. And I took a variety of compound financial instruments with you in the previous session, wherein we did the concept of a split accounting. And I think before I'm going to take forward, I'm going to do two things to begin with as a warm-up exercise for the day. Well, first of all, I gave you some MCQs to try. I think I'm going to first answer those MCQs which I gave you in the previous class. Then we'll take a very quick recap in terms of the different kinds of compound financial instruments which we talked about. And then there is a little special agenda which we need to cover in terms of compound financial instruments, and that is a case of early redemption. Then I think the most important aspect what we're going to start today is Index 109, which is, I think, one of the core areas which covers the aspect of accounting of financial instruments. So I think let's first of all start with the MCQs with you, which I gave you in the previous session. So let me, I think, start with the MCQ number 1. I said the amount in tab number 1 of SOKI always gets fully transferred to the tab number 2 of SOKI. Well, mind the words, as I said that the entire amount which is there in the tab number 1, I'm talking about the equity component of compound financial instruments always gets transferred 100% to the tab number 2 of SOKI. So is that true or is that false? Well, I would say technically, no, it's not true. Because especially if you're looking in terms of, let's say, compulsorily convertible instruments, then in those particular cases, the equity component gets split between the share capital and the security premium. So it's not technically right to say that the full amount in tab number 1, which is the equity component, gets translated into a security premium. In that particular case, there is a split in terms of the share capital to the extent of the face value, and only the excess gets translated to the security premium. So I would say technically this is supposed to be a false statement. And I think I got wonderful answers on that. Good morning, Manini. Good morning, Rashmi. And I think your answers are perfectly correct, but that's right. Okay, I'm getting answers related to the future questions as well. Great. Okay, so this was the first one, and now the second one. Now, this is related to a compound financial instruments that in case of a perpetual debt instruments, irredeemable debt instruments, financial liability includes only a return component. And that, yes, absolutely correct. Because we've seen that in terms of irredeemable debt, the issuer has got an obligation only to pay the return on that instrument for perpetuity. So when you calculate the financial liability element, we consider only the present value of the interest which you pay on that particular instrument. So this is absolutely true. And I think that answer was absolutely correct as well. Right, Nidhi? Right, Rashmi? Absolutely correct. Great. Then let's have a look at the third one. It says, again, in terms of compound financial instruments, in case of OCD, optionally convertible debenture, or OCPS, optionally convertible preference share, financial liability will include both the principal and the return. Well, of course, I think I didn't make it very clear, but I think let me mention that in this particular case, I'm considering the option to convert is with the holder. Now, if the option to convert is with the holder, then yes, the issuer has definitely got an unavoidable obligation to pay both the principal as well as the return on that amount. So this statement absolutely true in nature. And I think I already got your answers. That's absolutely correct. Great. Wonderful indeed. Then number 4, which was a little discussion based on our schedule 3, it says in calculation of a basic earning per share, we consider a total comprehensive income. And I think you already know that as well, that when you calculate a basic EPS of the company, we consider only the profits from the P&L section. Whatever enters in the other comprehensive income is a part of the total profit or loss of the company, but it doesn't go in the calculation of the EPS for the current year. So this statement is absolutely true, absolutely false, because we don't take total comprehensive income, but we consider only the profits which are there in terms of the P&L section. Okay, so I think the fourth one that was right is absolutely false. Great. And finally, the fifth one, what enters the OCI in income statement goes to the tab number 3 of SOCI. As I told you that SOCI has got a total of 3 tabs, and whatever is taken to the tab number 3, which represents the OCI section of the income statement, that one particular day definitely enters the tab number 2. So to the extent as of our discussion so far, because this statement could, undergo a change later, especially after you've done Ind AS 19, but I think I'm not inserting that as of now. So I think with the facts known to us as of today, then we can say point number 5 is true. Because let me tell you, there is an exception where items in the OCI are technically not totally taken to the tab number 2. So I can only say that everything which enters in, of course, what goes in OCI goes in tab 3, but there is an exception. There is 1 or 2 items which goes in the OCI, but they don't enter the tab number 3. I'm not discussing that at the moment. It's related to Ind AS 19, that certain portions which are taken in the OCI doesn't go in the tab number 3. Incidentally, it's taken to the tab number 2. But as of now, we can say, yes, the statement is absolutely true in nature. Okay, so I think that was a wonderful performance indeed. I think we got some good answers coming in on this stage. Great, wonderful indeed. Okay, now before I take it further, we've discussed the MCQs. I think a little quick recap on our concept of compound financial instruments. I hope, I trust that you've already revised the concept what we have covered in the previous class, and you did these questions by hand as well. So I think first of all, let me just do a little consolidation in terms of what we learned on the split accounting of a compound financial instruments, the 3 main agendas, what you need to take care when you do a split accounting, and then I take the journey forward. Now, if you recall what I covered in the previous class, I took different types of compound financial instruments with you. And the variety of compound financial instruments ranged from a perpetual debt instrument. It was a perpetual debt instrument, that's one. Then it was a case of, I said, a mandatorily convertible instrument. So let me put it as MC, mandatorily convertible. Then I covered the concept of partially convertible. Let's put it as PC. And I covered the concept of optionally convertible, that is OC. So these are the 4 kind of compound financial instruments which I covered with you in the previous session. Now, as I said, when you're working on the split accounting of compound financial instruments, one of the most important aspects is to calculate the financial liability component in a split accounting. So we need to be very clear that when you consider the split accounting in terms of a CFI, then do you consider the principal and do you consider the return components or not? So we made it very clear that when you consider a perpetual debt instruments, we do not consider the principal element because it's irredeemable in nature. But yes, we certainly consider the return element. And in this case, you'll end up taking the amount of interest as an annuity. And we consider the present value of annuity. So you are comfortably taking the interest as the annuity divided by the rate of interest on that particular instrument. So we are able to get the financial liability element. Now, when it comes to a mandatorily convertible instrument, then in that particular case, since it's a mandatory conversion, we do not consider the principal element in this case. The unavoidable contractual obligation is only in terms of the return element. So we segregate the financial liability based on only the return element in this particular case. Okay, let's take this further. And thereafter, when we went to the case of a partially convertible instrument, now we need to be careful. When you consider a partially convertible instrument, we did take the principal element, but not the entire element. It is only the non-convertible portion. I'm putting it as NC. Only the non-convertible portion enters the calculation of the financial liability. And of course, we consider the return element as well. And then comes the case of an optionally convertible instrument, wherein, of course, I'm assuming that the option to convert is with the holder. And I would say that even if the question is silent with this regard, you should always assume that the option is with the holder. And you can also safely assume, if nothing is given, that the fix for fixed test is met. I repeat, if we are given an optionally convertible instrument, I think the safest assumption, if there is nothing to the contrary, is to assume that the option to convert is with the holder. That's one. And secondly, you should also consider that in this case, the fix for the fixed test is met. So in which case, I would segregate only the financial liability and the equity component of the instrument. So in terms of optionally convertible, there is an unavoidable obligation to pay both the principal as well as the return. So this is one focus point. We need to be very clear that when you consider a compound financial instruments, then which particular case we consider the principal and which particular case we consider the return. I guess I'm pretty clear on the first aspect of CFI. Then I gave you another input in terms of things that we should also be very clear that what happens to the equity component identified at the inception. So when you did the split accounting, you segregated the equity component, and this equity component at that particular stage was reflected in the tab number 1 of SOKI. So at the time of split accounting, we would have taken this in the tab number 1 of SOKI. It would be a part of the other equity in the balance sheet of the company, and it is reflected in terms of the tab number 1. Now, if you say that it is a perpetual debt instruments, then of course this equity component remains intact out there. Because since the conversion, in this, it's an irredeemable debt instrument, so this particular amount would remain intact in the tab number 1 itself. Now, the second situation, if it is supposed to be a mandatory conversion. Now, if it is a mandatory conversion, remember, at the end of the life of the instrument, this amount will be split in terms of the equity share capital to the extent of face value, and the remaining is taken as a security premium. So this equity component, you can say, is going to be partially converted to equity share capital to the extent of the face value, and the remaining becomes a security premium, and this portion of security premium technically enters the tab number 2 of SOKI. Because in the tab number 2, we've got a security premium. So this particular portion, which is only the premium portion, enters the tab number 2. Similarly, if I look at the third one, that's a partially convertible instrument. Here again, the treatment is similar, because whatever is the portion in the equity component, that would again get split in terms of the equity share capital to the extent of the face value, and you consider the security premium, which shifts from tab number 1 to tab number 2. So the treatment of mandatorily convertible and a partially convertible is, of course, the same. Now comes the agenda in terms of optionally convertible instrument. Now, in terms of optionally convertible instruments, the equity shares will be allotted through the financial liability ledger itself. I think if you have picked up what I did in the previous class, you know this very well, that in the last year of the instrument, the holder gets an option to either take a cash or to take equity shares. So the allotment of equity shares in terms of optionally convertible instrument takes place through the financial liability ledger itself. So in this particular case, the entire portion goes to the security premium. So whatever is the total component of the equity component, everything enters the tab number 2, that is in the form of security premium. I hope I'm pretty clear in terms of the treatment of the equity component, which is done at split accounting. What happens to that at the end of the life of the instrument? So either it remains intact in terms of irredeemable instrument, or in terms of mandatory and partially convertible instrument, it gets split between the face value and the premium. And if it is optionally convertible, it gets converted to security premium. But there is another caution. I also gave you that this will get converted to security premium if the holder opts for shares. If the holder says, I want shares, then I would put it the security premium of the tab number 2. But if the holder says that I am wanting cash, then in that particular case, it gets transferred to the capital reserve. So it'll definitely go to the tab number 2, but it may go into a different component of the tab number 2. So if the holder says, I want shares, then you're going to put it in security premium. But if the holder says, I want a cash, then you're going to put it in capital reserve in terms of tab number 2. I guess I'm pretty clear on my second chain of thought as well on this. Wonderful indeed. So this is one aspect. Now, then there is another aspect which I tell you need to be careful. And if you're very clear in terms of the financial liability component calculations, the equity component treatments at the end of the life of the instrument, then the third aspect is that there is a use of a discounting rate. And this discounting rate is used at two places. One is that it is used at the place when you calculate the financial liability at initial recognition. Second is you need a discounting rate for unwinding purposes in the ledger. Because when you make a financial liability ledger account, in that particular case, you need to attribute a finance charge. So you need to be careful that in a situation, if you know that the transaction cost is nil, if you know in a particular question the transaction cost is supposed to be nil, in all these cases, the rate which is used in the financial liability ledger, in the calculation of the financial liability, and in the ledger account is same. So the rate at which the financial liability element is computed and the rate on the basis of which the finance charge in the ledger account is computed remains the same. But in a situation, if there is a transaction cost is given in the question, you need to be careful in this particular case. So in this particular case, immediately what should come to the mind is that there is a need to recompute the effective interest rate. In this case, the rate which is used for the financial liability calculations and the rate which is used in the ledger account is going to be totally different. Because in this case, there will be a need to calculate the new effective interest rate as well. Right, I guess I've made myself very clear. This was the learnings which we developed. And I said, I'll give you a quick revision before we take the journey forward. So I think if you now look at all the varieties of compound financial instruments, we've got a clarity on three important agenda. What is the portion taken for split accounting financial liability calculation? The treatment of the equity component at the end of the conversion, and what is the discount rate to be taken for the financial liability calculations and the discount rate to be taken for the unwinding of the discount, that is the finance charge in terms of the ledger account. Right. I guess everybody quite comfortable and I guess absolutely clear with the thoughts. Okay. So now with this particular agenda in hand, Claire Sai, wonderful indeed. Claire Banani, wonderful indeed. Now, let me now take you to the next agenda in terms of compound financial instruments. Very easy. And this is called a case of early conversion. This is a case of, we can say, early redemption, early conversion. A company has issued an optionally convertible instrument, and before the date of maturity, they plan to go in for a conversion. How do you tackle the early redemption of a CFI? Now, what I'm going to do, I'm going to explain this special agenda with the help of an illustration which is given in the study material. So let me take you now to the study material. So this is a question which is given in the study material as well, but I've also organized a similar kind of question. So maybe you can try illustration number 34. Let me, I think, take a slightly different question with you. I'm taking a question on my own, and this is a question which came in RTP 2018, and this has come in MTP August 18 as well, and it's also come in MTP October 2020 as well. And I think, if I'm not wrong, I think it recently came in another part. Yes, another similar kind of question came also in RTP November 21. So I think let's do one thing. Let's do the latest RTP question with you. This is a November 21 RTP question. So let me read the question number 50th out to you. It says on 1st April X1, PS issued 6,000 9% convertible debenture with a face value of 100 each, maturing on 31st March X6. So this instrument has got a total life, you can say, to the extent of 5 years. The debentures are convertible into equity shares at a conversion price of 105. Now, mind you, there is sometimes a mistake people do in this case. When you go to convert the debentures into equity shares, the conversion price is 105. We are not redeeming the debentures at 105. It's not a case of redemption at a premium. It's a case of conversion. And for the purposes of conversion, the price of the equity share is taken as 105, not redemption at 5% premium. Then he says interest is payable annually in cash. At the date of issue, the non-convertible debt could have been issued by the company at a coupon rate of 13%. So the company issued these convertible debentures at a 9% coupon rate, whereas the same debentures with a non-conversion would have been 13%. I think it indicates optionally convertible. Suppression of a liability definitely indicates a compound financial instrument. Then he says on 1st April X4, which is just 3 years later, the convertible debentures have got a fair value of 6,30,000, and the company PS Limited makes a tender offer to the debenture holders to repurchase at 6,30,000, which the debenture holders accepted. So it's a case of early redemption. The life of the instrument was maturing on March X6, but they made an offer on 1st April X4, and the debenture holders accepted for early redemption. Then he says at the date of repurchase, the company could have issued a non-convertible debt with a 2-year term remaining. That means if you would have issued an instrument with the same maturity, mind the words, if you would have issued a non-convertible instrument on the same date, having the same maturity of conversion, that's another 2 years, the coupon rate would have been 10%. Then he says show the entries in the books of PS Limited for recording the equity and the liability component at the initial recognition, 1, and at the time of repurchase, that means at the time of early redemption. So to begin with, the question is going to be solved exactly the normal way. We will just consider the concept of split accounting, segregate the proceeds, which is 6 lakhs, in terms of FL and in terms of equity. So let's do this. So I am going to solve this question with you to begin with. So, okay, just give me a second. Oh, I think I closed my board on that. Just give me a second. Let me just open up the board. No worries. I'm just going to change the color as well. Okay, so I think let's start solving this question with you. So this is a question from the RTP November 21. I'll share this question also with you, no problems. I'll share the PDF today after the class, so no worries on that. So let's, I think, begin the journey in this case. Now, first of all, what we need to do at the time of split accounting, on 1st April X1, the convertible debentures were issued. So we consider 1st April X1, we are doing the split accounting. And when we're looking at the split accounting, we first take the proceeds as a base. And we know the proceeds is to the extent of 6 lakh The companies issued a total of 6,000 debentures with a face value 100 each. And we're going to split this in terms of the financial liability element and the equity component as usual. Now, the very first question what comes to the mind is, I am nowhere given that it's a mandatory conversion or it's a partially convertible. So I think I'm safely considering that it is an option to convert in the hands of the holder. And I'm also safely assuming that the fixed for fixed test would get passed. So we just need to consider the FL and the equity element. And in terms of the FL, we've got a liability to pay a 9% coupon rate. And this is for the next 5 years. So we got to pay, number one, on the 6 lakh rupees, a 9% coupon rate, which is going to be paid for the next 5 years. So we need a discounting at 13%. So let's take a 13% factor, 1 divided by 1.13, 5 times, twice, 3, 4, and 5. So my factor is 3.517. And we've also got an obligation to pay the 6 lakh rupees at the end of the 5th year. So let me take the factor at 13% 5th year. So 2, 3, 4, and 5. So this is, I think, 0.543. So we have taken two components in terms of the financial liability. One is the interest obligation for the next 5 years, and one is the principal repayment at the end of the 5th year, discounted at 13%, which is prevailing on a non-convertible instrument. So this is 54,000 into 3.517, 189918. So this is 189918, and this is 0.543 into 6 lakh. That's 325,800. So if we add this up, I think this is coming to 515,718 if my calculations are correct. So the financial liability is 515,718 is the answer. Okay, then we can take the equity as a balancing figure. So out of 6 lakh rupees, we take the balancing figure that comes to 84,282. So this is 84,282. Just see if the calculations are correct, I guess. So this is the split accounting we have done at the time of initial recognition of the compound financial instruments. Now, this equity component will enter the tab number 1 of SOCI, and of course, it continues to be the same. So I'm not worried on that. I'm just going to make a ledger account now related to the financial liability elements. So let's do one thing. Let's make a ledger account for the financial liability element only up to the date of early redemption. So I'm going to consider the ledger account for the financial liability for a period of 3 years. We'll make the ledger account up to the date of early conversion, early redemption, I would say. So we put the entry by bank on 1st April X1, and that's to the extent of 515,718. Then we apply the unwinding on this and consider the finance charge on this. And this will be taken at the rate of 13%. And fortunately, we don't have any transaction costs. So we're very, safe that the rate which is used to calculate the financial liability, the same rate is being used to calculate the finance charge in the ledger account as well. So 515,718, we take a 13% unwinding that comes to 67043. And then we make a payment at the coupon rate, which is 9%. So that works out at 9% on 6 lakh is 54,000. So we get a balance CD as a balancing figure. And we're going to make this ledger account for a period of 3 years that is up to the date of early redemption. So 515,718 plus 67043 minus 54,000. And this works out at 528,761. We go to the next year, take this as an opening balance. So that is 528,761. Again, we consider the unwinding of discount, that is finance charge at the rate of 13%. So 13% comes to 68,739 approximately. 68,739 approximately. And we make again a payment at the coupon rate, which is 54,000. And we get the balance CD as a balancing figure. This is second year. So 528,761 plus 68,739 minus 54,000. So that works out at 543,500. This is the ledger balance at the end of the second year. Pretty simple and pretty straight. Then let's also make a ledger account for the third year as well. And I think we're just making ledger account for a period of 3 years because that was the play time when the early redemption took place. So balance BD, and that is to the extent of 543,500. We again consider the unwinding of discount on this and take 13% finance charge. So 13% on this works out at 70655. And again, we make a payment at the coupon rate, which is 54,000. And we're able to get the balance CD as a balancing figure. This is the position now at the time of early redemption. So this works out as a balancing figure. And that is 560,155. 560,155. Trust me, we've not done anything so far. I've just taken the split accounting the usual way we do. Then I prepared my amortized cost ledger of the financial liability, and we've just done the unwinding of discount in this particular case. Now comes the crucial calculations at this stage. Now we are given the information that on this particular date, the company, the issuer, offered the holders that let's go for early redemption. So let me just come back to the question. So now we're given that on 1st April X4, which is 3 years later, the convertible debentures have got a fair value of 6,30,000, and the company makes a tender offer to the debenture holders to repurchase the same at 630, and they accepted the offer. And on the date of redemption, I'm very clearly given that if you look at a coupon rate prevailing on a non-convertible instrument with a 2 years maturity, the same maturity as the original instrument, the coupon rate is supposed to be 10%. So what we need to do now at this stage, logically, if you think the company is giving 6,30,000 to the holder, but in the books of accounts of the holder, there are two components. One is the FL component and what is the equity component. So even this offer price of 6,30,000 is supposed to be split in terms of the FL and the equity component. So when there is going to be an early redemption, the offer price, which is 630 in this case, needs to be again split. And that's the reason it says, show the accounting entries for recording the equity and the liability component at the time of initial recognition and at the time of repurchase. So at the time of repurchase, we need to again go for a split accounting. Let's see how. So 6,30,000 is supposed to be the offer price. And again, we need to split this in terms of financial liability and the equity component. Now, at this stage, what we'll do, we'll consider whatever is the remaining obligations. They will be discounted, but not at the existing rate, not at 13%. You need to calculate this financial liability on the discount rate, which is prevailing on the date of early redemption, which is 10%. He's already given us that if the company would have issued an instrument with a 2 years remaining maturity, the rate would have been 10%. So the split accounting on early redemption will be considered based on this new rate, which prevails on the date of early redemption. Now, the company has got a liability to pay a return for the next 2 years. So on that 6 lakh rupees, they're liable to pay a 9% interest for the next 2 years only. And then they're liable to pay this principal amount of money after another 2 years. So we take a 10% discounting rate. So if I take a 10% discounting rate for 2 years, second year factor is 0.826, and the cumulative factor for the 2 years is 1.736 approximately. So we've taken the split accounting based on a 10% discount rate. So another interest for the period of 2 years and the principal redemption at the end of the second year, this gives me the financial liability. As usual, we take the equity component as a balancing figure. So 54,000 into 1.736, 93744. And the principal element is 0.826 into 6 lakh. So the sum total of this is going to be 589,344. That becomes the financial liability element of the instrument. So we take the balancing figure equity, and that comes to 40656. Super. So the only thing which we need to do at this particular stage is again do a split accounting, but remember you need to consider a new discounting rate at the time of early redemption. Now I think my data is organized. Now we're just 2 minutes away in terms of doing the accounting. Now what do I need to do at this particular stage? I have, number one, the book value of my financial liability element, and I have a book value of the equity component as well. Over a period of 3 years, you've done the amortized cost accounting of the financial liability. You've got a book value for the same. So if you go back and look at the ledger account, that 560155, that figure of 560155 is the book value of this liability. And the equity component was also split initially. That was 84282. That was 84282. So look at the book value, and you will compare this with the figures what you've just calculated. So right now we did a split accounting of the repurchase price, and that is coming to 589,344. So what you're paying, what the issuer company is paying towards the financial liability element is 589. Though in the books of accounts of the issuer, the liability is standing at 560, but he is making a more payment. This results in a loss on settlement of the debt component. And as far as the equity component is concerned, the payment towards the equity component is less as compared to the book value of the equity component. And this would result in terms of, you can say, a gain to us. So we can put two entries after making this comparison. So if you look at this comparison, let me give you the journal entry. We're going to pass with reference to the payment of 630, one portion paid towards the liability, the debt component, another portion paid towards the equity component. So you can say the existing financial liability will be given a debit, which is 560,155. And against the book value of this liability, you will make a payment. So bank will be given a credit that is to the extent of 589,344. So we're going to get a balancing figure in this particular case, and the balancing figure is going to be taken to the profit and loss account. This represents the loss on settlement of the debt component. So we can say that this is a loss which we got on a debt settlement. So 589,344 minus 506,155. We're getting a balancing figure of 29,189. So this is how the liability component will get closed in the books of accounts after making a payment of 589. And the difference becomes a debt settlement loss, so which is taken to the profit and loss of the company. Similarly, we'll also consider the equity component. The equity component which is standing in the books of accounts is 84282. And against this, we're making a payment. So bank will be given a credit, and that is to the extent of 40656. So this time we've made a lesser payment against a book value, and this becomes a gain. But this gain is not to be taken in terms of P&L. This gain is going to be taken directly to SOKI, that is equity. So when we say that it is directly taken to equity, that means it's not rooted in the profit and loss account. It's going to be directly taken in the appropriate heading in terms of SOKI, statement of changes in equity. So this is the balancing figure. That's a gain on the settlement of the equity component of the CFI. So 84,282 minus 40656, that works out at 43626. Right. So this is how the accounting of a compound financial instrument is done if there is a case of early redemption. So all you need to do is a simple concept. First of all, you do your split accounting, which is done at the initial recognition. Make your financial liability ledger up to the date of early redemption. That's one. Then at the second stage, you again do a split accounting, and that is at the date of early redemption. And then in stage number 3, just compare the book value of the liability component and the amount paid against the liability component. So whatever is the gain or loss against the liability component is taken to the P&L account as a gain or loss. And then also compare the book value of the equity component and what you paid against the equity component. So any balancing figure is directly taken to equity, unlike the debt component. The debt component gain or loss is taken to the P&L, but the equity component is taken directly in terms of equity. Right, friends, I guess I am pretty clear on the special agenda in terms of early redemption. Okay, I think Rashmi, you had a question. I guess will 43,626 transferred to capital reserve? Okay, so this money, yes, will be directly taken to equity. And I think technically, yes, if you ask me that which component of equity, you're right, we're going to put this in capital reserve. So in the examination, you can show that it's been taken to equity, which is supposed to be SOKI directly. That's absolutely correct. Okay, so I think this is done. So we are done with the aspect of Ind AS 32 with you, friends, now. I am done with the concept of Ind AS 32. Now I am going to start with the concept of Ind AS 109. I think we've had our enough discussion with reference to, you can say, the Ishwar point of view, looking at the concept that when it is equity instrument, when it is financial liability, when it is a compound financial instrument, or when is it a hybrid contract. And we've also seen the accounting in terms of a compound financial instruments, the split accounting, and also a special agenda that is early redemption of a CFI. Okay. Now, from this particular stage, before I go to Ind AS 109, I think what is now important is to introduce you to Ind AS 109 certain things. You know, I am first going to build your logics. And because this is going to be a very crucial standard now, which will also develop your understanding based on, you can say, the concept of OCI and based on the concept of SOKI. So herein, I think I have a little obligation, which I would say both contractual as well as a constructive obligation in terms of building up your concept related to the concept of other comprehensive income and related to the concept of SOKI. So before I take you to the Ind AS 109, I'm now going to tell you a story, friends. And based on the story, I'm going to give you some logics, because as I'll proceed further, I am actually going to create some base concepts to you so that, when I start the journey on Ind AS 109, I'm going to directly get some answers at your end. So this story is going to build up your entire logic. So be very careful as you hear my story, because this is something which is going to build up your concept on a step-by-step approach. So let's begin the journey. Okay, so I am now taking you to the inputs, wherein I'm considering the accounting which used to be and the accounting which is. Earlier we used to have the concept of IGAAP. When I talk in terms of IGAAP, I'm talking of the accounting standards. When we look at the term IGAAP, I'm looking in terms of the accounting standards. And on the other hand, we've got Ind AS. Now you would say, so why are you telling us about IGAAP? Well, I think there are certain issues which were dealt differently in IGAAP and they are dealt differently in Ind AS. So it is very necessary to understand the logic. So let me, I think, first of all, make a request to all of you. The next 1 hour is going to be very, very crucial, friends. I said the next 1 hour is going to be very, very crucial for you. Because whatever concepts I'm going to build in the next 1 hour is going to become your foundation in terms of Ind AS 109. One can avoid doing this discussion as well, but then I think you'll not be able to appreciate the standard in its real sense. So I think I'm going to spend that 1 hour with you, which is going to be very crucial in terms of building the concept on Ind AS 109. If you get this hang in the next 1 hour, trust me, you're going to become logically very clear on a lot of things. But let's, I think, begin the journey. Now, as I said, I'm looking at a comparison in terms of IGAAP, that is accounting standards, and in terms of Ind AS. I am looking at the measurement techniques which were available in IGAAP. And I'm looking at the measurement techniques which are available in Ind AS. Now, if you look at IGAAP, largely the accounting was based on what we call a cost approach. Largely, the accounting was always based on a cost approach. And this cost approach is what we technically call a historical cost approach. Now, let me tell you, my discussion is with reference to Ind AS 109. I'm not talking in journal, but I'm talking in terms of the measurement aspects related to Ind AS 109. So, IGAAP, there was only practically one approach of measurement, that you record things at a historical cost approach, record what you pay, record what you receive. So when you pay something, you record the asset at what you pay. When you receive something, you record at what you receive. Ind AS, made a little changes to the concept of a cost approach, and they introduced a concept of what we call an amortized cost approach. I think last class somebody asked me a question as well, and I said that I'll give you a detailed logic and explanation in the next class. So today, I think you're going to get your answer as well. So there was a first change which the Ind AS made, and that is a changeover from a historical cost approach to an amortized cost approach. Now let's understand why. Let's understand why there was a change from a cost approach to an amortized cost approach. So I want to understand the logic of changing the historical cost approach to a new approach of cost that is called amortized cost approach. But let me tell you, I am again telling you caution, I'm talking in terms of financial instruments. It's not that the amortized cost approach is not used in other standards, but typically I'm looking at the introduction of the amortized cost approach in Ind AS 32 and in Ind AS 109. Now, let's understand why this approach was introduced. Let's take an example. Now, let's consider an example to appreciate this. Let's say my company borrowed, let's say 10 lakh rupees. So if there is a company, let's say XYZ Limited, and my company, let's say, borrowed money to the extent of 10 lakhs. And I agreed to pay an interest rate, which is, let's say, 10%. And let's say the tenure of this particular borrowing is, let's say, 5 years. So the company XYZ borrowed 10 lakh rupees and the interest rate is 10% for a period of 5 years. Now, in this particular case, let's also consider that this is a market rate as well. Now, let's consider that this is a contracted rate, and let us consider this is also the market rate. I think the deal will certainly happen. If I go to someone and say that I want to borrow 10 lakh rupees from you, I'm willing to pay the market rate of interest itself. I think the person would easily pay me money, and I would be, getting this loan money. I don't see any troubles in this case. Now, imagine what we were doing in terms of IGAAP. Imagine what we're doing in terms of IGAAP. Let's say if I make a T-shaped profit and loss to understand, when I borrowed 10 lakh rupees and I agreed to pay a 10% rate of interest, the interest recorded in the profit and loss was 10%, that is 1 lakh. Every year, I used to pay interest at the rate of 1 lakh rupee, 10%, and that was taken as an expense in my profit and loss account. Simple and straight. Now, there is another transaction. Let's understand another transaction. Now, instead of this, XYZ Limited, did something else. I'm giving you another transaction. This was one transaction, which was borrowed money at a market rate itself. Now, XYZ did one thing. It says I borrowed 10 lakh rupees. And when I borrowed 10 lakh rupees for a period of 5 years, I told the other person that I will not be able to pay you a 10% rate of interest. I will not be able to pay you a 10% rate of interest. I said I'll pay you an 8% rate of interest. Now the other person will not give me a loan. If he knows that the market rate of interest is 10%, why would he give me a loan at the rate of 8%, which is below compared to the market rate of interest? He will never deal with me. He will not give me a loan at a below market terms. Unless I have some related kind of transaction with him, he will not agree to give me a loan at the rate of 8%. So I tell him, boss, don't worry. Since I'm not paying this 2% interest, you're getting a loss of 2% to compensate, mind the words, to compensate this loss of 2%, what I'll do, I'll pay you a premium on redemption. I'll pay you a premium on redemption. And let's say he agreed to pay a premium or redemption of 10%. He said that on the money of 10 lakh rupees, at the end of 5 years, I'm going to pay you 11 lakh rupees back. Now, one thing is pretty clear. Why would anybody agree to pay a premium on redemption? Can I say I would agree to pay a premium on redemption only because I have not paid him the 2% interest for the next 5 years? So money is borrowed at a low rate of interest, and naturally to compensate that low rate of interest, we told the person, don't worry, I'm going to give you that compensation in the form of premium on redemption. If I'm already paying an interest rate based on a market rate, I would never pay a premium on redemption. It's simple. If I'm compensating the other person based on a market terms, then there is no need of making a premium on redemption. The only situation where you agree to pay this premium on redemption is that when you say, okay, the interest rate is 8% below market terms, and to compensate the loss, you're going to pay a premium on redemption. Now look at the implications. In this case, if XYZ company records the interest in the profit and loss account, he would say that I paid an 8% interest, and if I paid an 8% interest on 10 lakh rupees, he would record a finance charge which is 80,000. Oh my God. Now this becomes very interesting to watch. Look at the two negotiated deals very carefully. Now hear this very carefully, what I'm about to say. Look at the two negotiated deals very carefully. In the first deal, you agreed to pay a market rate of 10%. So the interest hit in your profit and loss account is 1 lakh rupee. In the second deal, the interest rate hit is only 80,000 because you agreed to pay a lower interest rate to be compensated by the premium on redemption at a later date. And this premium on redemption, when it is paid, can be adjusted against a security premium also by the companies. I'm talking of IGAP. I'm talking of IGAPs. Companies, when they would have paid a premium on redemption, that can be set off against the security premium at a later date. Now, let me ask you something, vouch me. See, if the company is entering into the second kind of deal where the interest rate is lowered down, compensated by the premium on redemption, is it able to reduce the burden of finance in such a way they agreed that they will pay a low interest followed by a compensation in the form of premium on redemption? Has he manipulated? Has he, manipulated the burden of the interest cost on the profit and loss of the company? What do you say? Am I thinking correct? By entering into such kind of a deal, what they've done a complete manipulation, and that's rightly agreed. So this is what, companies understood. That they understood one thing. Now hear this very clear, very important inputs I'm giving you. The companies understood one thing, that since the basis of accounting was the contracted rate of interest, the finance charge which was getting recorded in the profit and loss of the company was the contracted rate of interest. They started making deals in such a way that they lowered down the interest rate on the instrument and they compensated that money with the help of premium on redemption. Now, this was understood by the standard setters, and they came to understand that people are manipulating the contracted rate of interest because they want to pay a lesser interest and reduce the burden of interest on the profit and loss of the company and then compensate it in the form of premium on redemption. And, if you remember, if you've done financial management and if you recall the concept in financial management, you would remember that when you calculate the cost of debt in terms of financial management, we always say that the cost of debt is not just the interest. You consider the I into Y minus T, saying that interest is just one element of the cost of debt, but there is also a difference between the redemption value and the net proceeds spread over the number of years. So you say the interest is one element. The interest is one element of the cost of the debt, and the premium on redemption or the discount on issue is also another component of debt. So financial management also considered the cost of debt, saying that if you say that what is the cost of debt, the money which is incurred to arrange a debt is not only the interest which you pay, but also the premium on redemption as well. And trust me, this TD is nothing but it is supposed to be an internal rate of return. So they decided that why should the contracted rate be the basis of accounting? Why should I consider the interest in my P&L on the basis of contracted rate of interest? A company pays a 10% interest and it lands up recording 1 lakh rupees interest in the P&L. Another company negotiates a deal and contracts at the rate of 8% and you record 80,000 interest in the P&L. So they said, we are introducing a new concept. And the new concept is that let's not consider the contracted rate as the basis of accounting. Let's consider the effective rate in the deal. Let's consider the effective rate in the deal and record the interest in the books of accounts based on that effective deal. Now, there is some very crucial question coming in. If you're able to answer this, then I think you've got my thoughts. Let me take it further. So what the standard setters decided is something very interesting to watch. The standard setters said, okay, you negotiate the deal as per your terms, no problem. You please negotiate the deal as per your terms. But what we're going to do, we will translate, mind the words carefully, we will translate the deal in terms of cash outflow and cash inflow. You negotiate the deal the way you like. You negotiate the deal the way you like, but we're going to actually translate your negotiation in terms of absolute data of inflow outflow from the investor's point of view. Let us translate this from the investor's point of view. So I'm looking at the first two examples only. The first case where you borrowed 10 lakh rupee at a market rate of interest. And I'm looking at the second deal when you borrowed 10 lakh rupees at 8%, whereas the market rate was 10%. So you agreed to pay the premium on redemption. So I'm now looking at the inflow outflow, not from the point of view of the borrower. The calculations of the inflow outflow will be seen from an investor's perception. Because when you calculate the internal rate of return, we always consider the investor's perception as a base. Now let's look at the deal number one. I'm looking at the deal number one, and I'm translating the deal number one in terms of absolute data. Can I say from the investor's point of view, at 0 point of time, I gave 10 lakh to the other company. I said, okay, I'm giving you 10 lakh rupees. You want to borrow this money, I give you 10 lakh rupees. That becomes my outflow at time 0. What is the inflow I'm going to get over the next 5 years? I'll get a 10% interest on this as an investor. So my inflow becomes 1 lakh rupees at the end of each year. And at the end of the 5th year, I'm also going to get that principal money back. So the deal which took place between the two people is translated in absolute data terms. Mind the words carefully. The entire deal is translated into absolute data terms, that this is the outflow at time zero, this is the inflow for the period of 5 years, and this is the inflow at the end of 5th year. If I were to ask you to calculate the internal rate of return, if I use the market rate of 10% to discount, if I use a market rate of 10% to discount, let me ask you now a financial management question. If you're going to discount this inflows at the market rate of 10%, do you think you will get exactly a present value 10 lakhs? I repeat, if you discount all your inflows at the market rate of 10% itself, do you think I'm going to get the internal rate of return 10%? The present value of 1 lakh discounted at 10% and the present value of 10 lakh discounted at 10%, do you think will equal 10 lakh rupees at time zero? What do you say? Am I making sense? And I think Sai says, no, sir. Okay, let me, I think, now take you to a little financial management. Let's do one thing, friends. We are trying to understand the logics, what you've done in financial management. Now, let me calculate this. 1 lakh multiplied by a 3-year factor, I think is 3.791. I just remember the factor. At 10%, 5 years is 3.791. And I think at 5th year, it's, I think, 0.621, I guess, if I rightly remember, is 0.621. Let's calculate the present value of this 1 lakh rupee, 3.791, and 10 lakh into 0.621. Wow, this comes to 10 lakh rupees itself. Great. Now, if you notice that if I use a 10% discounting rate, I am getting the same amount of 10 lakh rupees. I think, let me explain this a bit as well. Hear me well. I'm teaching financial management at the moment. Not financial reporting. I'm teaching you financial management. So watch me now carefully. Can I say the interest was compounded at the rate of 10%? Am I right? When I calculated the interest figures, I calculated the interest and compounded at the rate of 10%, right? And now you're discounting at 10%. If the compounding is at 10% and the discounting is at 10%, naturally, you're going to get the same figures, right? In this particular case, when you calculated the interest, it was computed at 10%. And now you are calculating the discounting at 10%. Compounding and discounting is at 10%. So we are getting the same results. I hope I'm clear. So which means in this particular case, the market rate of interest itself is the effective rate of interest. Was there any manipulation in the deal? There was no manipulation in the deal. So can I say the contracted rate and the market rate and the effective rate is the same? I hope I'm pretty clear on my first deal, friends. Understood? Great. I guess everybody is pretty clear on this. Now I'm going to go to the second deal. So in the second deal, let's again translate all this data in terms of inflows and outflow from the investor's perception. I'm looking at the deal number 2. Now, if I look at the deal number 2 from the investor's point of view, look at the cash outflows and look at the cash inflow. Let's look at the deal. And now something very important coming to you. Can I say from the investor's point of view, at time zero, I invested 10 lakh rupee. What is the inflow over the next 5 years? The inflow is supposed to be 8%, that is 80,000. And what is the inflow at the end of 5th year? Can I say it is 11 lakh rupee? Now, please watch me very carefully on what I'm about to ask. This is going to build your concept right away. So in the second deal, the person gives me an 8% coupon rate, contracted rate, but he pays me a premium on redemption. Now, let me ask you something very carefully. If that premium on redemption exactly compensates me for the 2% loss every year, I repeat, can I say if that 10% premium on redemption exactly compensates me for the loss of 2% 2% every year, do you think the internal rate of return of this deal, the effective interest rate of the deal, is going to come 10% itself or not? Let's get your answers at this stage. A very crucial question, friends, to you. So do you think in this particular case, if that, 10% premium on redemption exactly compensates the 2%, interest lost every year, do you think the effective interest rate or the internal rate of return is going to come equal to 10%? What do you say? And I like that. That's right, Manani. That's right, Aniket. Wonderful indeed. Beautiful. So I think I have made my point. So can I say, now I will tell the company XYZ, boss, you cannot consider your contracted rate as the basis of taking a finance charge in the P&L account. You got to consider the effective rate in the deal. So can I say, I think now a very important input. Can I say, what is the concept of amortized cost accounting? Is it switching over from a contracted rate of interest in terms of an effective rate of interest? Wow. I think I must be making complete sense. So can I say the historical cost approach had a manipulation end, where the companies were negotiating deals and they understood that the contracted rate becomes the basis of accounting. If I pay 10%, my profit and loss takes a hit of 10%. If I pay 8%, my profit and loss takes a hit of 8%. So people understood that if the contracted rate is the basis of accounting, let's manipulate the contracted rate. Let's negotiate for a premium on redemption. The concept of premium on redemption to me is a complete manipulation. Why would I agree to pay a premium on redemption to anybody if I am contracted at market terms? The very essence of making a premium on redemption is to manipulate that you don't want to pay a high rate of interest, a market rate of interest. So indirectly, let's not consider the contracted rate as a basis of accounting. Tell the people, you make your own deal. I can't stop people from making a deal. I can't tell them that you can't contract on your own terms. If the two people are ready, the person is ready to get a lower interest in the initial years to be compensated by the premium on redemption, I can't stop them from making a deal. But at least my profit and loss account should take an expense of finance charge, or it should take an income of finance income on the basis of the real income in the deal, the real expense in the deal, which is translating the contractual terms in absolute figures, deriving the hidden rate of interest in the deal, which is nothing but the internal rate of return, which is nothing but the effective interest rate. I guess, friends, I've made complete sense. Do vouch me if you've understood the concept. And Sai Venkat said, so no, sir, IRR is supposed to be different. Well, friends, effective interest rate is nothing, but it is supposed to be the internal rate of return in the deal itself. When you're looking at the effective interest rate, the EIR is nothing but translating, you can say, the effective rate in the deal. It's the internal rate of return. Right? I guess I'm pretty clear on this particular aspect. So the moral of the story, I'm going to now say something, vouch me on this aspect. So I'm just coming back to the concept of the discussion which we were doing. I said the measurement base in IGAP was cost approach called a historical cost approach. And in Ind AS, we said we're going to switch over and we're going to modify the cost approach into an amortized cost approach. So vouch me on what I'm about to tell you. If you're able to vouch me, then I think my concept is done on stage one. Can I say the historical cost approach is based on accounting using a contracted rate? The contracted rate becomes the base to record the finance charge and the finance income. But can I say amortized cost approach is saying, don't consider the contracted rate. Convert the contracted rate, the terms and conditions, into absolute data and derive an effective interest rate in the deal. So is it a switch over? Is it a switch over that accounting was based on a contracted rate of interest and now it is supposed to be based on an amortized cost approach, which is like considering the effective interest rate in the deal? Do you think I am correct on this? Vouch me. Understood, Sai. Wonderful indeed. I guess my other friends are also able to clearly get what I'm saying. Okay, so now let's do one thing. Let's do one thing in this particular case. So I am now understood one thing very clear. Let me depict this in terms of a ledger account as well. If you look at the ledger accounts of financial liability, which I have been making in a compound financial instruments, let's look at this. You first of all took the bank figure, which is the financial liability element, and then you calculated the finance charge on this. Now, let me ask you, is this the contracted rate or is this the effective rate? Is this the rate which I paid or is this the rate which I should have paid? So let me ask this once again, and you can vouch me. So is this the rate which I paid, or is this the rate which I should have paid? Are you looking at the effective rate of interest in the deal? Yes, I am looking at the effective rate in the deal. So are you recording this finance charge in the profit and loss account? Yes. And you know what you paid as a contracted rate was just converted into absolute data in terms of bank. Now you can see that whatever is the actual contracted rate, that contracted rate was simply considered as a payment in absolute figures. We're not considering the contracted rate as the interest payment. We're just saying that it's a repayment schedule of that particular liability. So we are recording the interest in the P&L on the basis of what is the effective interest cost and not on the basis of the contracted rate, and you get a balance CD as a balancing figure. I hope I am pretty clear on what I'm saying. So this was one transition. You know, somebody asked me a question, I think in the previous class, I think maybe it was Shobham. And I said, you know, that I'm going to give you the logics in the next class. So I think I have put forth my point that the concept of historical cost to an amortized cost approach is a switch over, because earlier our accounting was based on contracted terms. So let me now ask you something, friends. If you can vouch me, then I think you've understood the concept. So can I say, if I tell you that a company issued a 10% debenture, if a company issued a 10% debenture, is that supposed to be the contracted rate? Yes. Is that going to be the basis of accounting? You tell me yes or no. If I enter into a deal and I say that the contracted rate is 10%, so what do you say? Is that going to become the basis of accounting in Ind AS? A company issued a 10% debenture. So do you think that 10% coupon rate agreed is going to be the basis of accounting? Decide. And Manini, you said, sir, the contracted rate is lower than the market rate and the premium on redemption compensates the loss to the investor. What is the purpose of such an arrangement to the company? Well, as I said earlier, let me put this. And I think that's right, Manini, that's right, Rashmi, Koshki, I think you said yes, no. I think let me put this once again. Let me, I think, first of all, change your perception towards accounting. Let me, I think, consolidate this picture once again. Let's, I think, consolidate the entire learnings which I've given you with logics. Well, I think, let me first of all take you to the example number 1 and the example number 2, which I took a while back. A company borrowed 10 lakh rupees and agreed to pay a 10% rate of interest. If I were in IGAP, I would have said that I paid a 10% interest. So let me record 1 lakh in the P&L. Is your contracted rate become the basis of accounting? Yes. If you said that I'll pay 10% coupon rate, then you record 10% in the P&L 1 lakh. So your contracted rate, what you pay, becomes the basis of recording the expense in the books. Second deal. The company, manipulated the transaction. They told the other person, let me give you 8% right now instead of a market rate of 10%, but don't worry, you'll be compensated for the premium on redemption. And in this particular case, when your contracted rate become the basis of accounting, you took 80,000 in the P&L. So I think what you asked me, that what is the advantage of this manipulation? Can I say the advantage is that if your contracted rate of 8% became the basis of accounting, were you able to reduce the interest burden of 20,000 every year to the profit and loss account? Say yes or no. By entering into a manipulative deal, were you able to, manipulate and reduce the finance cost of 20,000 every year in the P&L? Because you know that the rate of interest contracted is the basis of accounting. If you pay 10%, you record 10% in the P&L. If you pay 8%, you record 8% in the P&L. So the company understood that they could lower down the interest rate in the deal and tell the other person, don't worry, we'll compensate you in the form of premium on redemption, considering time value of money. The other person would agree. Because if he knows that, he will be well compensated in such a way that ultimately he gets a 10% return, he's willing to contract with you. So what is the advantage for the company manipulating in the deal? Can I say that he is indirectly getting the advantage of reducing the finance burden in the P&L? So companies understood that premium on redemption was nothing, but it's a mere manipulative tool in the hands of the company. I guess I'm making sense, right? The companies well understood that, the concept of premium on redemption is just a manipulative tool. Ask yourself a question. Do you think if I borrow money at market terms, I would be willing to pay any kind of premium on redemption? No. The idea of making a payment of premium redemption is that I am compensating for the lower interest paid over the period of 5 years. I paid an 8% interest compared to the market rate of 10%. So the only way I paid this premium redemption is to compensate for the 2% loss of interest. Otherwise, why would I pay a premium redemption? So isn't that premium on redemption also be a part of the effective rate of interest calculations? Should I also not consider that there are two elements of the cost of debt? One is the interest and one is the premium on redemption. And that's what I said. That's what you do in financial management. When you calculate a cost of debt in financial management, you are considering two elements. You are considering the interest, there is one element. And when you take the redemption value minus the net proceeds, you're even taking the premium on redemption. So effectively, that means, and what is KD? KD is nothing but it is the internal rate of return. So the standard setters had something in mind, that people were manipulating their contracted rate of interest so that they could reduce the interest burden in the P&L. So they said, okay, we can't stop people. We can't stop the people from negotiating deals. So if two people are ready to negotiate a deal at two different terms, you cannot stop them, even though the substance of the deal might be the same. So look at now the two deals. In first deal, the person said, I give you 10% interest, no premium. So I took his deal in absolute data and I identified that the effective rate is 10%, no manipulation in the deal. The contracted rate, the market rate, and the effective rate in the deal is the same. But look at the second deal. In terms of the second deal, if you lay down the data in absolute data, we know that we are getting 8% every year and we're getting 11 lakhs at the end of fifth year. So the contracted rate is 8%, but what is the effective rate in the deal? It's 10%. So tell the two people that both of you will record the interest in the profit and loss based on the effective rate, which is supposed to be the internal rate of return of the deal. So does this mean, moral of the story, that if two people negotiate what I should do, I should first translate the negotiations into absolute data and then calculate the effective rate of interest in the deal? Is that correct to say? I put it again. Can I say, I'll tell the two people, please go ahead and negotiate your deals. and I'm going to actually, translate your negotiated deal in terms of inflows and outflows in absolute data. And I'm going to derive what is the substance of the deal, which is called the effective interest rate in the deal. I guess I am making complete sense, friends, so far. Okay, Claire Shobhan, Claire Koshki, wonderful. And Rashmi, could you show the calculation of the deal number 2? I can, but then, I've taken arbitrary figures and I may not be able to prove that, the 10% premium exactly compensates the 2% not, because I've just created a question, arbitrarily. But I can prove that, but it's going to take a lot of time to do that. But trust me, I said very clearly, if the 2% loss of interest is compensated exactly by 10% premium on redemption, according to time value money, then it is definitely going to be. Okay, and Rashmi, you said that means interest is not 80,000, it's going to be 1 lakh every year. Yes, absolutely correct. So the company which made a deal 1 records the profit and loss interest expense 1 lakh. The company number 2, which made a deal number 2, is also going to record the interest expense of 1 lakh in the P&L. So have we streamlined the system? Have we killed the manipulations of the company that you structure your deal? Not a problem. But we're going to find out the effective rate of interest in the deal, and that becomes the base of accounting. So moral of the story, vouch me, friends, on this. Moral of the story. So can I say, what is the switch over from historical cost approach to amortized cost approach? Is it a switch over from contracted rate of interest to the effective rate of interest in the deal? True or false? I repeat, is the concept of switch over from a historical cost accounting to amortized cost accounting a switch over from a contracted rate of interest to an effective rate of interest in the deal? What do you say? And that's rightly vouched, yes. So in this particular case, we can undoubtedly say, yes, this is the case, right? I hope I'm pretty clear so far. Now let's take you further. Because, one thing is that you understand the logic of the concept. The other is you just remember this is how it is done. Well, the idea is not just to tell you, that this is how it is done. We should also understand that why the concept of the amortized cost accounting was introduced. Because of the manipulations in terms of things which were done by the industry. And I hope I've made myself clear that it's a switch over from the contracted rate of interest to an effective rate of interest in the deal. Okay, now let's take it further. And let's discuss more things with you. I'm back to the concept in terms of the measurement basis, and there is now another interesting discussion which I'm going to do with you, and this is going to take time. As I said, we're going to spend almost 1 hour. We've still got another around 25 minutes to go in further with this. So I'm looking at IGAP, and I'm looking at Ind AS. I'm looking at IGAP and I'm looking at Ind AS. Now, apart from the concept of historical cost movement to amortized cost movement, there was another change which was brought in. Again, I'm speaking in terms of financial instrument standard. And that was the introduction of a fair value approach. And that was an introduction of what we call a fair value approach. If you look at IGAP, I'm not saying that the fair value approach was not there, but I would say it was quite missing. I would say largely we were looking at a cost approach in terms of accounting, but in Ind AS we see another approach which has been introduced, and that is called a fair value approach. Now let's first appreciate why a fair value approach was introduced. There's still a divided opinion between accountants world over, and some people believe that a fair value approach is not logical. Some people believe that a fair value approach is logical. There is a divided opinion, but all said and done, the fair value approach has come to the Indian accounting standard. Now, what was the basic thought process of the same? Now, let me give you some example to understand the concept of fair value. And this is again going to be linked to your financial management concepts, what you've done. Now let's have a look. I'm taking two examples, number one and number two. Now I'm looking at as an investor's point of view. I'm looking at an investor's point of view. So let's say I made an investment at 10%. I made an investment at 10%. This is the market rate as well. And this is the contracted rate as well. No hanky-panky. So I made an investment at 10%, let's say for 1,000 rupee. So if I were to make my profit and loss account, can I say considering the contracted rate and market rate is same, the effective rate is 10%. So you would record a finance income in the profit and loss to the extent of 100. Correct? So if I make an investment, which is for 1,000 rupees at a 10% rate of interest, then considering it's the effective rate of interest, you record a finance income at the rate of 10%. Second, let's say I invested into the equity shares of a company, and in terms of equity shares, I again invested 1,000 rupees. Now, if I go with the IGAP, in this particular case, we used to receive a dividend on these equity share. Let's say the dividend received is 20 rupees per share. So I recorded the dividend income in my P&L. Now I am looking in terms of what was happening in terms of IGAP. Mind you, I'm looking in terms of what was happening in the IGAP. Now, let's say at the end of the year, the price of the equity share, let's say comes to 1,200 rupees. Let's say the fair value of the share at the end of the first year is 1,200. IGAP used to prohibit me that you cannot record this 200 as an income in the P&L. IGAP used to tell me that this is not to be recorded. You cannot record this gain as a part of the P&L. But let me ask you something, friends. When you calculate the return in a portfolio management, you know, we always say that the concept of return is supposed to be dividends plus P1 minus P0, the price of the share 1 year hence minus the price of the share, which is as of today. The concept of return includes not only the dividend, but the concept of return also includes the capital appreciation on that particular security. So this means that when you're capturing the return from the income tax point of view, capturing the return from the accounting point of view, you need to capture two components of return. You need to capture the return in the form of interest and dividend, and you should also capture the fair value changes as well. And unless you record the investment at a fair value, you will not be able to capture the concept of 200. Now, immediately you will tell me, sir, this is unrealized in nature. So how can you capture the unrealized gains in terms of profit and loss account? This will give us a total wrong position. Well, I'm not saying that this fair value change will always be taken in the profit and loss account. This fair value changes could also be taken in the other comprehensive income section as well. And remember what I gave you last time, that when a change in the fair value will enter the profit and loss section, it'll impact the EPS of the company. But when you consider the fair value changes in the OCI section, it does not affect the EPS of the company, right? But all said and done, I think the intentions of the standard setters was very clear, that they wanted to capture the concept of return. That return is not merely the interest and the dividends you get on the investments. The interest, the amount of return also includes the capital appreciation of that investment. If the company's price of the investment has increased from 1,000 to 1,200, I think it makes sense to logically capture that as well. Let the company elaborate that, you know, they have also earned a return in the form of capital appreciation. Especially in case of certain investments, the return doesn't come, really in terms of dividends. The return technically comes in the form of, you can say, the capital appreciation, especially in terms of equity investments. So they introduced the concept of a fair value approach in order to measure the financial assets and the financial liability. Now, you will logically agree with this or not, that doesn't make a difference technically, because this approach has already been introduced. So I think I'll not get into the controversy of saying that it's a good or a bad approach, but the net result is, yes, this approach is very much valid in terms of accounting now, right? Now, as we've understood that why a fair value approach was introduced, because there was a need to capture the change in the value of the investment, which was never allowed in terms of IGAAP. Because if you remember, in terms of IGAAP in Accounting Standard 13, we always used to say that investments are taken at cost unless there is a permanent reduction. We never used to capture the gain. Even if it was supposed to be a short-term investment, it used to be taken at cost or market price, whichever is less. We never used to capture the gain in terms of Accounting Standard 13. But Ind AS has introduced the concept of what you call a fair value accounting, that we are certainly going to capture the gain. We are also going to capture the loss. The fair value changes in terms of gains and loss will be taken. Now, moving further. So, as the standard setters introduced the concept of a fair value approach, something more and very interesting also came to their mind. And they created, you can say variations of fair value changes. They introduced two kinds of fair value approaches. They introduced one is called a fair value through profit and loss. And they introduced another approach which is called a fair value through other comprehensive income. They said that when you're going to record the investment in the books of accounts at a fair value at each balance sheet date, we will either capture the change in the fair value in the P&L, or we will capture the change in the fair value in the other comprehensive income. So let me, I think, remind you a few parameters for, because I'm going to develop something relating to when to apply which approach of measurement. I'll give you some general principles of which approach is to be followed. Then I'll be able to apply all this to Ind AS 109. Now, let's, I think, take this further. Let's consider that this is the profit or loss for the period. I think this is what you remember is the P&L account. So this is the profit loss for the period. This is, you can say, the profit and loss section of the income statement. And then this is, let's say, the other comprehensive income section. So this is the OCI section of the income statement. As we know that the profit and loss account is supposed to be, divided in two parts, but it's a running format. You can say one is the profit and loss section and one is the other comprehensive income section. So when you say that the fair value changes will be taken in the P&L, so let's say the investment at the beginning of the year is 2 lakh and the investment at the end of the year is 3 lakh. So when you say that I am taking the fair value changes through P&L, you're going to put that fair value increase in the P&L. But if you say that the fair value changes are taken in the OCI, so you're going to put that in the other comprehensive income. So the fair value changes either enters the P&L if it is fair value through P&L, or the fair value changes enters the other comprehensive income if it is supposed to be OCI. Now let's imagine that you've got a total profit of 2 lakh rupees. So this is what we call is the total comprehensive income. Now, if I say that the number of equity shares of the company, let's say the number of equity shares of the company is, let's say, to the extent of 10,000 shares, would you like to tell me what is the basic earning per share of the company? I think I asked that question last time as well, but I think I'm asking this question again. So I am now looking in terms of that what is the basic EPS. So I said if the profits of the company is 1 lakh and the number of share is 10,000, my basic EPS is 10. The changes which you have taken in the P&L account is affecting the profits and the EPS. But the changes which you have taken in terms of the OCI is affecting the profits, but not the EPS. So they were very careful. They introduced two concepts in terms of, you can say, two concepts in terms of the fair value changes. They said one is supposed to be, you can say, the fair value change which is taken in the profit and loss account. And that is going to affect the profits, and that is also going to affect the earning per share of the company. And the other one is, which is going to affect the profits of the company, but it is not going to affect the earning per share of the company. I hope, friends, I'm making sense, right? The company in this particular case would have to decide that if you record the change in the fair value through the profit and loss account, it impacts the profit, it impacts the EPS of the company. But if you go to record the changes in the fair value in the OCI section, the profits are affected, but the earning per share of the company is not. So they had a very scientific way of dealing with this particular situation. They decided that we'll have to make a call and decide that in which cases we apply an FPTPL and in which cases we apply an FPDOCI. Now, I'm going to look at these same things from a different perspective, friends, and I'm going to ask you a question. Let's see what is your insights on that. I'm going to look at this fair value concept from the approach, what I felt that if I were to create a measurement base, I am now going to give you some inputs. So effectively, if you consider what are the different measurement bases available, if you ask me that what are the different measurement bases available in Ind AS in financial instruments, I would say one is the cost approach, and we can say it is the amortized cost approach, where the fair value changes are not taken, where the fair value changes are not incorporated. If the accounting is done using an amortized cost approach, a fair value changes are not captured in the books. So is there any impact on the profits due to fair value changes? No. Is there any impact on the earning per share of the company? No. Get this very clear. If a company uses an amortized cost approach, you don't record any fair value changes in the profit and loss or in the OCI. So there is no impact of any fair value changes in the P&L, and there is no impact on the EPS as well. Second is we're using an FPTOCI approach. Does the fair value changes get incorporated in the OCI section? Yes, it does. So it impacts the profits of the company, but it doesn't impact the EPS of the company. And then the third approach they introduced is what is called an FPTPL. And in terms of FPTPL, again, the fair value changes are recorded in terms of the profit and loss section, and it affects the EPS as well. Wow. So understand the implications of the three measurement bases which are given in Ind AS. If a company is using an amortized cost approach, there is no fair value changes incorporated in the books. So the profits are not affected due to fair value changes. The EPS is unaffected. When you consider a fair value changes through other comprehensive income, in this particular cases, the fair value changes enter the OCI. So it definitely affects the profit section, the profits of the company, but there is no impact on the EPS. And when you consider a fair value through profit and loss account, again, the fair value changes are incorporated and it is taken in the P&L section, impacting the profits in the EPS. I hope I'm very clear on the three measurement bases, friends, to you. I hope I'm very clear on the implications of the three methods, that when a company is applying AC, the impact of the fair value changes in the P&L, no. EPS, no. When the company is considering the concept in terms of FPDOCI, profit impact, yes. EPS impact, no. And when the company is using an FPTPL, the EPS impact and the profits impact both is supposed to be a yes. Wonderful indeed. Now the question comes, which approach would be applied in which case? Is the earning per share a very important tool? Yes. So to my mind, how I look at these measurement bases goes something like this. I'll be able to connect you a little better when I connect this with financial instruments, but my mind works on this, that in a situation where a company takes no risk, you should give them an amortized cost approach. What I felt looking at the application of Ind AS 109, that the standard setters had this in mind, that if you are looking at a situation where there is no risk, now you would say, sir, how would we make an assessment that there is a risk or not? There are certain tests which are given in the standard. The standard has given us certain beautiful tests which elaborates that, that test will help you to decide whether there is a risk or not. It's not a gut feeling of a situation where we'll decide risk. There are certain risk assessment kind of a test which is given in the standard, which will help us to decide, which particular measurement base to be applied. But in a situation, by applying those particular tests, we reach a conclusion that there is no risk. We should apply an amortized cost accounting. If you say that there is definitely a risk, then we should say that if a company is taking a risk, give them a fair value approach. Because risk and return goes hand in hand. And in this particular case, if the company is taking a risk, then they are able to generate that return or not. Let that return be captured as a part of the profits of the company. And if you see that they are taking a very high risk, then give them a FPTPL approach. And if they are not taking that high a risk, it's not that high, then I'm going to give them an FPT OCI approach. So my thought perception is very clear that the standard setters introduced the concept of a fair value accounting. And this fair value accounting will be considered whenever we feel that the company is taking a risk. So in a situation where the company doesn't take any kind of risk, we'll see how to assess a risk. So if we see that the company is not taking any kind of risk, we will suggest an amortized cost approach. But if the company is taking a risk, then we'll definitely go for a fair value approach. And if you say that the company is taking a huge risk, then we'll suggest an FPTPL. And if we consider the risk is not that high, then we're going to consider an FPT OCI approach. I think, let me first consolidate this picture once again to you before we're going to take the journey forward. So now let me consolidate the learnings, what I've given you in the last 1 hour. As I said, my 1 hour is going to be devoted in terms of, building the concept to you. So I think I've almost built up the concept. Now let me just, consolidate the picture. This was IGAAP and this is Ind AS. So we understood two very important inputs. Number one, we were applying a historical cost approach and we switched over to the concept of an amortized cost approach. What was the basis of distinction? The historical cost approach was considering a contracted rate as the basis of accounting. The amortized cost approach switched over to the concept of effective interest rate accounting. People were manipulating deals and they were creating a premium on redemption. So we said, boss, no longer a contracted rate of accounting, but we're going to consider an effective rate of interest accounting. One. Secondly, we introduced a concept of fair value changes. We said we want to capture a fair value change, even though it is unrealized in nature, but we want to apply a fair value. This approach of fair value will be applied in which cases? The concept of a fair value will be applied when you see that the company takes a risk. We go for a fair value approach. How do you assess a risk? There are tests which are given in the standard, which helps me to identify that the risk is there or not. We're going to see those tests very shortly. Similarly, if you say that the company is not taking risk, we don't see that there is any kind of risk in the situation, then we use an amortized cost approach. Because in AC, amortized cost approach, the fair value changes are not captured. Since the fair value changes are not captured, we will use an amortized cost approach when we see no risk. A company, if it takes a risk, will take a fair value approach. And that also, if you say that the risk is too high in nature, then we'll go for FPTPL. Let their profits and EPS be affected. More risk should mean let their earning per share be an index of their performance. And if the risk is not that very high, then we can give them an FPT OCI. Let the profits be affected, but not the EPS at this stage at least. So this is the entire crux with logics which I've given you, that which measurement base will be applied in which case. So why a switchover from historical cost to amortized cost approach, introduction of the fair value approach, and in which cases we use a AC, we use a FPTPL, and we use an FPT OCI. I hope, friends, I am pretty clear so far at this stage. I guess we are pretty clear so far at this particular stage, and I think it's time to give you a little break as well before I link these concepts, the introduction which I've given you, and I link them in terms of Ind AS 109. So almost around 8:45. So I think we take a 10 to 12 minutes break with you, and then I'm going to commence back with you after that. Wonderful indeed. So I think let's take a break now, friends, with you. So we're just going to take a 10, 12 minutes break, and I'm going to join you back. Welcome back, friends. So I hope you had your mental rest as well. So I think let's quickly take a quick look at what we have done. I think there's one particular question. Koshi said, so question number 45. The financial liability ledger does not vanish, nor it is near to vanishing. Does not vanish. Okay, you mean to say that there is still a little difference coming in that particular ledger? Maybe some rounding of errors due to which you might get a slight little difference. In the last year, you can always take the finance charge as a balancing figure to close that ledger, because there could be slight little difference because of those things. So just take a balancing figure and you can close it. Okay, now I think before I link all this to the concept of Ind AS 109, I think let's get some few principles what we have developed so far, so that we can, link this in terms of Ind AS 109. So in the last 1 hour of my discussion, what I've done, I've created certain principles, I would say, for the purposes of accounting. The first thing which I built with you is that there has been a switch over. There has been a switch over, you can say, from a historical cost approach to an amortized cost approach. And I think we have understood the logic that why did the standard setters want the companies to switch over from a historical cost approach to amortized cost approach? Because the historical cost approach was considering the contracted rate of interest as the basis of accounting. But in an amortized cost approach, we said, let's look at the deal and identify the effective interest rate. So you will not see in financial instrument standard any concept of a cost approach. Trust me, everywhere you record a finance income or you record a finance charge. So whether you're recording a finance income on a financial asset or you're recording a finance charge on a financial liability, you will nowhere see that we are considering contracted rate as a base. Everywhere, when you're applying a cost approach, we would be applying the concept of the effective interest rate only. That's one important conclusion. That interest is not what you pay. Interest is not what you receive, but interest is what you should have received. Interest is what you should have paid. So a transition from a historical cost approach to amortized cost approach switches us to the concept of what should have been paid rather than what is paid. What should have been received rather than what is actually received. The contracted rate is just a bank movement. Mind the words carefully. The contracted rate is just a bank movement, but the amount of interest income or the interest expense to be taken in the profit and loss account is based on the effective rate of interest in the deal. That's one. Second, we decided that we introduced the concept of a fair value approach, and the concept of fair value approach was introduced only so that we could capture the capital appreciations as well. We could capture the return. The total return is not only the interest and the dividend, but the return is also including a capital appreciation. So there are certain financial assets where it is important to capture the capital appreciation. Typically, you can say equity investments. So the standard setters had this in mind, that the return is comprising of not only the interest and dividends on those investments, but also the concept of capital appreciation. So they introduced the concept of a fair value change. And the third and the most important aspect which I have given you is that when you're working in terms of selecting a measurement base for accounting, you need to consider the perspective of risk. Now, how is the risk evaluated? There are certain tests which are given in the standard, which we'll very shortly come to. Ind AS 109 is given a certain kind of test with the help of which we will be able to decide whether there is a risk or not and whether the risk is high or low. So there are different kind of tests available in the standard, which will tell us the assessment, the presence or the absence of risk, and also the fact that whether the risk is high or low. But we made a conclusion that if you see that there is no risk in a given situation, We will tell the company to use an amortized cost approach. The reason is simple, that if they've taken no risk, we don't want to capture the fair value changes such that it does not result any impact on the profits of the company, because they're not taking any kind of risk. So we will tell them that there is no need to capture the fair value changes, and it will not affect the profits of the company and neither the EPS of the company. So no risk would mean that you are comfortably using a cost approach. And if you say, yes, there is a risk in a given situation, then I'm definitely suggesting a fair value approach. The moment we find that a given situation leads to a risk, whether it is high or low is a secondary factor, but the situation indicates the test of the assessment tells me that there is a risk, we'll tell them to use a fair value approach. Now, in terms of the fair value approaches, we can say there are two things. One is a FPTPL and one is a FPT-OCI. In terms of FPTPL, you're going to capture the change in the fair value in the profit and loss section. So when you're going to capture the change in the fair value in the profit and loss section, so what will happen? There will be impact on the profits. What will happen? There will be impact on the EPS of the company as well. The profits will get affected, the EPS will get affected. So this kind of measurement base would be applied when we see that the risk is very high. You know that there is a risk. Yes, there is a risk, but at the same time, we make an assessment that there is a high risk. There are tests which will help us to decide whether the risk is high or not. And if you take the FPT OCI, the fair value changes will be taken in the OCI section, which will definitely impact the profits of the company. But the best part is that when you incorporate the fair value changes in the OCI, it does not impact the EPS of that year. So when you see that the company is not taking that high risk, it's not that high. So if it is not that high risk, then I'm going to use this particular concept. So these are the three important principles which you need to apply in Ind AS 109. One is that there is no concept of contracted rate accounting. It is an accounting based on the effective interest rate. That is one. The second, we need to apply a fair value approach because we want to capture the return in the form of not only the interest and dividends, but also the capital appreciations. And number three, we need to keep in mind that the selection of the measurement base is going to be purely based on a risk assessment. And I give you the logic as well, that if a company is not taking a risk, we don't want the profits and EPS to be affected. So we'll end up using an amortized cost approach in that case. But the company is taking a risk, then I would always say that let's use a fair value approach. And within that, you've got two variations. And depending upon the level of risk taken, if you feel the risk taken is too high, the risk assessment test tells me the risk is high, FPTPL, impacting profits and EPS in the same year. But if the risk is not that high, then FPT OCI, impacting the profits but not the EPS. So these are the three different measurement bases. Now, there is something more which I'm not going to talk right now, but when you look at FPT OCI, there are basically two sub approaches in this case as well. One is called an FPT OCI R and one is called FPT OCI NR. There is recycling and no recycling. We'll be discussing that very shortly, but not at the moment. So I'll be coming to this part also, that in terms of OCI, there are two further sub approaches. So effectively, if you say there are total 4 measurement bases in Ind AS 109, one is called amortized cost approach, one is called a fair value through P&L approach, FPTPL, one is a fair value through OCI, which has got no recycling, and one is called FPT OCI with a recycling. But we'll come to the concept of recycling and no recycling later. Right, I hope, friends, I am pretty clear so far on this particular area. So let me now take it further. Now, what I'm going to do, I'm going to first of all show you a very interesting chart, which is there in the unit number 2 of the study material. Let me remind you, now I am effectively starting Ind AS 109. I've been making certain broader concept building to you in the last 1 hour, where I've introduced the 3 principles on which we're going to do the accounting. Now I'm going to start with Ind AS 109. Now, as I start with Ind AS 109, I think in the first instance, let me give you a few inputs to start with. So let me, I think, first give you a few inputs as I start with Ind AS 109. If you remember, when I started with financial instruments on day one, we said that there are two parties to a contract. One is called issuer and one is called holder. And I made it very clear after the understanding of Ind AS 32 that when the issuer applied Ind AS 32, he decided that a given instrument is either a financial liability, or he decided that it is an equity instrument, or he decided that it's a compound financial instrument. Let's not talk of hybrid for the time being. So it could be a financial liability or equity instrument or compound financial instruments. And we said that the holder would always land up saying that it is a financial asset for me. Now, in Ind AS 109, the first thing I'm going to do, I'm going to now start focusing on the holder. Till now, my focus has been on the issuer. I've been concentrating on the equity and liability side of the balance sheet. But now my focus is changing to holder. Not that I'm not going to discuss about the issuer in this Ind AS, but to begin with, our focus is now going to be on financial assets. So at the first instance, what I'm going to do, I'm going to concentrate on financial assets measurements. So now see how my chain of thought is going to go with you. I'm going to discuss the financial assets measurement initially and subsequently. That when a financial asset is recognized in the books of accounts initially, how is it initially measured? And when it is subsequently measured on the balance sheet date, then how does a financial asset get measured in the balance sheet date at each reporting date? So we're going to concentrate on financial assets, initial measurement and subsequent measurement. Then I'll come to back to the issuer. And we will again discuss the financial liabilities are measured initially and subsequently on what basis. So our core area in this particular standard is going to deal with measurement. As Ind AS 109 talks about recognition and measurement, my focus from the examination point of view is going to be on the measurement aspect. How do you measure the financial asset initially and subsequently? One, how does the financial liability gets initially measured and subsequently measured? Then I'll take you to more aspects. Like, for example, after the measurement aspects is done, I will be coming to the concept of derecognition of this financial assets and liability. So first we are dealing with the recognition part, that once you recognize them in the books of accounts, how do you measure them initially and subsequently? One. Then we're going to come to the aspect of derecognition of this financial assets and financial liability in the books of accounts. Then there will be certain more interesting areas which we need to deal in the standards. And I would say typically three areas will be there. One is the concept of that hybrid contract, what we said, embedded derivatives. The other aspect is in terms of impairment testing, which is done for financial assets. Unlike IAS 36, where impairment testing is done in a different style, there is another impairment testing which is called the ECL model, which we will learn in Ind AS 109. And then we'll come to the concept of what you call hedge accounting. So three different kinds of special issues will be covered. The concept of embedded derivative, the concept of impairments, and the concept of, you can say, hedge accounting. But for the time being, we're just concentrating on the aspects of measurement. And that also, as I said, my focus right now is in terms of financial assets. I'm going to focus now on the holder, financial assets. After I'm done with financial assets, then I'll speak in terms of financial liability. Okay, now let me do one thing. Let me just now bring you to the study material. So I am now coming to the study material, and this is the unit number 2. This is the unit number 2, and I think let me illustrate this chart to you now. Just a second. This is a beautiful illustration, a beautiful decision tree, which is given in terms of elaborating the measurement of financial assets. It's a beautiful chain, and I will not be able to complete this entire chart today. But trust me, at least 50% of the questions on this chart, you will be able to answer with whatever concept building I've done today. Trust me, you'll be able to do this. But before I go to this particular chart, what I have done, in order to illustrate this particular chart to you, I have again created a 3-step model. We'll be able to cover every aspect of this particular chart with logics to you. But for this purpose, what I've done, I have created my 3-step model. So I'm going to give you a 3-step model based on which we are going to decide things. So let me just come back to my board and share the 3-step model to you. Now you would say again, a 3-step model in Ind AS 109 as well? Yes. Just like we created a 3-step model in terms of Ind AS 32, here also I'm going to create a 3-step model in terms of 109. Now, hear me very carefully. Hear me very carefully. My focus is on financial assets. When you measure the financial assets initially, it is always measured at fair value. It is always measured at a fair value. Now, you've already done, I guess, fair value. And that was Ind AS 113, where you've covered the aspect of fair value accounting, right? Now, let me at this stage tell you one thing. One is called a transaction value and one is called a fair value. So there are two things. One is called a transaction value and one is called a fair value. Let me, I think, illustrate this with an example. When we were in IGAAP, how we used to calculate a passer entry? I invested 10 lakh rupee. So I gave 10 lakh to someone. So we used to say that let's put the entry investment account debit to bank. So I invested 10 lakh rupees. So this is what I gave to the other person. So this is what we call a transaction value. IGAAP used to consider the recording at a transaction value. Transaction value is the value at which you transact. But it is not necessary that the fair value and the transaction value will be same. Now, for the time being, let me tell you what is a fair value. You can say it is the present value of the future cash inflows which will arise. My asset is not what I invest. My value of the asset is not what I invest. If I invested 10 lakh rupees, my asset is what I'm going to get. And what I'm going to get in a future discounted to time value of money. So let's say, for example, if I invested, let's say 10 lakh rupees and I'm going to get a 10% interest for the next 5 years, then what is my fair value? You can say you're going to get 1 lakh rupees at the end of each year. So you're going to get 1 lakh rupees at the end of each year, and you're going to get that 10 lakh rupees at the end of 5th year. So the present value of all those future inflows is what we can say is a fair value. Now you can well, I think, vouch me for this. If I say that I'm going to get a 10% interest at the end of each year, and if you want to calculate the fair value using the same 10% rate itself, do you think I'll get the fair value and transaction value same? Let me put this again. Let's say, for example, I invested 10 lakh rupees today, and the other person told me that I'll give you a 10% interest at the end of each year. So he pays me 1 lakh rupees in absolute figure at the end of each year, and he repays the 10 lakh rupees at the end of 5th year. Now, if I calculate the present value of all those inflows at the same rate at which I calculated the interest, do you think I'm going to get that figure of 10 lakh rupees itself? Yes, I will get the same figure as it is, rightly said. So there is a possibility that transaction value and fair value can be same, but they can be different. So for the time being, friends, to make it very easy for you, what we're going to do in all the questions, what we're going to do for the time being, I'll assume transaction value and fair value is same. We will do a separate discussion with you. When I am done with the initial discussions, we will come as a specific discussion that if a transaction value and fair value is not same, what are the reasons they are not same? And how do you account for the difference if the transaction value and fair value is not same? But for the time being, for convenience, let's not bother ourselves at the moment. And let's consider that transaction value and fair value same. Which means that if I invest 10 lakh rupees today, it's my transaction value. And the present value of the interest and the principal which I will get back is also the fair value. Let's say that is also 10 lakh. So let's consider transaction value and fair value is equal, but they can be different. But what does the standard Ind AS 109 tells me? It says that you need to record the financial asset initially, not at a transaction value, but you're going to record it at a fair value. To make it very clear, am I indirectly saying that if you were to make an investment, then the financial asset should be given a debit at a fair value? Yes. And the money which you invested, the bank should be given a credit at a transaction value? Yes. I think when you were in school, we were taught this thing that the amount of the debit and the credit side of the entry is same. We always used to be given that when you put an entry investment, debit, bank credit, the amount of the debit and the credit side is same. But today, I've changed your perception that when you record a financial asset, initially it is taken at a fair value and the bank is taken at a transaction value. But for the time being, we are considering the transaction value and fair value is same. But we'll come to that later, that once there is a difference, then how do you tackle the difference? We will see that later. At this stage, let me also tell you, this is the case even for financial liability. Let's say if you borrowed money and you created a financial liability in the books of accounts, the entry is bank account debit and loan will be given a credit, that is financial liability. The financial liabilities are also initially taken at a fair value. The financial liabilities are also initially taken at a fair value and the bank will be taken at a transaction value, which for the time being, I'm considering the fair value and the transaction value same. So remember one thing, that all the financial assets and all the financial liabilities are initially taken at a fair value, but there are certain exceptions. There are certain exceptions that when the financial assets and financial liabilities are not initially taken at a fair value. So let me give you those exceptions also. It would be technically right to say that all the financial assets are taken initially at a fair value, but there are certain exceptions. And what are those exceptions? When you record a trade receivable, when you record your debtors, when you record a trade receivable, it is recorded at a transaction value and not at a fair value. Similarly, in terms of financial liability also, there is an exception where we don't record at a transaction fair value, but we record it at a transaction value trades payable. Just like a financial asset, a trade receivable gets recorded at a transaction value. Similarly, a financial liability trades payable is taken at a transaction value. Then there are certain loans which are recoverable on demand. You've given a loan to someone and that loan is recoverable on demand. Then also it is taken at a transaction value and the fair value concept doesn't apply. And similarly, if there is a liability and there is a loan which is payable on demand, it is again supposed to be taken at a transaction value. So get one thing very clear, that the financial assets and financial liabilities for the purposes of initial measurements are all taken at a fair value with the exceptions of trade receivable and trade payable, and with the exception of loan, which is recoverable or payable on demand. They are taken at a transaction value, and otherwise these two items, everything else is taken at a fair value. This is on the initial measurement part. Now coming to the next chain. So we said always at fair value, and I give you the exceptions on a trade receivable and exceptions of a loan which is recoverable on demand. The second is when you look at the financial assets to be measured subsequently. When you look at the financial assets to be measured subsequently on each balance sheet date, then the measurement of the financial assets depends whether it is measured at amortized cost, or it is measured at FPTPL, or it is measured at FPT OCI. So it is for the purposes of subsequent accounting of financial assets, we need to classify these financial assets into amortized cost or a fair value through P&L or a fair value through OCI. Again, I put it again, a very important concept, that when you initially measure the financial assets, even though it is subsequently taken at AC, initially it is taken at a fair value, friends. The initial recognition of all the financial assets is going to be at a fair value, even though subsequently it will be taken at amortized cost, where the changes in the fair value will be ignored on the balance sheet date. So the classification of the financial assets is required from the point of view of its subsequent accounting. That on the balance sheet date, do you apply AC, FPTPL, or FPD-OCI? Liabilities, we'll talk later. I guess I'm pretty clear on my thoughts so far, I guess. Okay, I think I got some message from Vinay. Okay, can you also explain AG 2123 regarding the application guidance? We will come to that later, not at this stage, not at this stage. Okay, so let me now, I think, take this further. So I have given you the inputs in terms of the financial assets initial measurement and the subsequent measurement. And I said that all financial assets initially measured at a fair value, and with the exceptions of a trade receivable, and with the exceptions of, you can say that there is a case of a loan recoverable on demand. Subsequently, we need to consider amortized cost accounting or a fair value through P&L or a fair value through other comprehensive income. Okay, now I think let's come back to the chart which I showed you. This is the chart which I showed you, and I said I am going to create a 3-step model based on this. So let me now give you my 3-step model. So this is the chart which is applicable for subsequent measurement of financial assets. We're going to classify the financial assets into various categories, AC, P&L, OCI, depending upon a 3-step model. So let me now give you the 3-step model, what I am going to follow. So let's have a look at this very carefully. Don't worry, I'll illustrate this model very well to you, but I think let's start with my 3-step model. Step 1, step 2, and step 3. In step number one, what do you need to do as a holder? You need to step into the shoes of the issuer. Mind each and every word carefully. You need to step into the shoes of the issuer, and you need to put across a question that if I were the issuer of this instrument, what would I call it as? So as a holder, you need to first of all step into the shoes of the issuer. And you need to see that if I were an issuer of this instrument, and if I were to apply Index 32, then what would have been the position? Let's say if I decide it's a financial liability from the issuer perspective, it is supposed to be called a financial asset debt investments. I'm adding something, friends, now. I'm going to call this as a financial asset debt investments. Earlier, I was only calling it as financial asset. Now I've changed the terminology and I'm saying it's a financial asset debt investments, right? Okay, if from the issuer point of view, it is supposed to be a compound financial instruments. If from the issuer point of view, the instrument is a compound financial instruments, the holder will say it's again a financial asset debt investments. But if from the issuer point of view, it's an equity instrument. If it is an equity instrument, then I'm going to call it as a holder that it's a financial asset equity investments. Got the point in step number one? The step number one is pretty simple. As a holder, you need to step into the shoes of the issuer. As a holder, you need to step into the shoes of the issuer. So if you say that it's a financial liability, then the holder would say it's a financial asset debt investments. If he says it's a compound financial instruments, then I would again say it's a debt investment. And if you look at and say that it's an equity instrument from the issuer perspective, it's a financial asset equity investments. So you would classify The financial assets as a debt investments, or you would classify them as equity investments. Now, if you go back to the chart, friends, you can see on the top of the chain, there is a debt investments and there is an equity investments. Forget about derivative investments for the time being. We go to talk that later. So I think now you're clear. What is that debt investments? Is it those investments which are financial liability for the issuer? Yes. Is it those investments which are compound financial instruments for the issuer? Yes. And what is equity investments? Is it those investments which are equity instruments from the issuer point of view? So before you classify that the financial asset is a debt investment or the financial asset is an equity investment, you need to step into the shoes of the issuer. You need to put across a question to yourself that as an issuer, if it is FL, for me as a holder, debt. As an issuer, if it is equity investment, for me as a holder, equity investment. As an issuer, if it is a compound financial instrument, it is again supposed to be a debt investment. I hope I am pretty clear on that. I am pretty clear on this, I guess. Okay, not a problem. So I guess I'm pretty clear on this particular aspect. Let's now take it further. This is my step number one. This is my step number one. Then I go to the step number two. Now, what do I do in step number two? Watch this carefully. In step number two, I said everything depends upon a risk assessment. So in step number two, I will do my risk assessment test. In the step number two, I will do a risk assessment test. I'll conduct a risk assessment test in terms of step number two. Now, this risk assessment test is given a nickname and it is called CCFC, comprising SPPI test. Oh my God. Now you would say what a technical name it is, but a very interesting name. So the risk assessment test is that it is called by the name of CCFC, comprising SPPI. Now what does that CCFC indicate? The CC means contractual. The CC means contractual cash flow characteristics. It is called contractual cash flow characteristics. So when I use the word CCFC, it means contractual cash flow characteristic. Now, what is that CCFC? Don't get bothered on that. We'll understand what is CCFC very shortly. But you need to conduct what you call a CCFC. We need to see the contractual cash flow characteristics. Is it comprising of SPPI? That is called solely payment of principal and interest. It is comprising solely payment of principal and interest. So this is what we call CCFC SPPI test. This is a test which will help me to decide, is there a presence or absence of risk? Mind it carefully. This is a test which will help me to decide, is there a presence or is there an absence of a risk? So this will tell me that risk is there or the risk is not there. So my risk assessment test, which is called a CCFC SPPI test, will help me to decide that there is a risk or there is no risk. As I said, that if there is no risk, I'm going to use an AC. And if there is going to be a risk, I'm going to apply a fair value approach. So my step number two will typically help me decide that do I follow a fair value approach or do I follow an amortized cost approach? So this test will help us the presence or the absence of risk. That is step number two. Then you go to the step number three. Then you go to the step number three, and this is what I call it as a risk intensity test. I call this step number three as what I say is a risk intensity test. Now you would say that these terminologies are not given in the chart. Don't worry. CCFC SPPI is mentioned, but I've just given two nicknames. I'm looking at the risk assessment test, and I'm looking at the risk intensity test. Now, when I say the risk intensity is going to be telling me that is there a high risk or is there low risk. So the step number 2 identifies the presence or the absence of risk. The step number 2 tells me that the risk is there or not. The step number 3 is going to tell me the intensity of the risk, that the risk is high or low. Because if it is going to be high, I'm going to use FPTPL. And if it is going to be low, then I'm going to use an FPD-OCI. And in this case, there are 2 different types of tests. Let me now caution you. In my step number 2, the risk assessment test is common for debt and equity investment. I repeat, in my step number 2, the risk assessment test is common for a debt equity investment. So whether you're looking at a debt investment or you're looking at an equity investment, there is a common test. But if you're looking at the step number 3, there is a different test for a debt investment and there is a different test for equity investments in terms of checking the intensity. And in terms of the risk intensity for a debt investment, we've got what you call a BM test. That's called a BM test. It's called a business model test. The BM stands for what you call a business model test. So we're going to apply what we call a business model test. That's a BM test. And when you're looking at equity investments, we are going to apply what we call an HFT test. We apply what we call an HFT test. So there is going to be a different test for a debt investments and a different test for equity investments to identify the intensity of the risk. This HFT test is called held for trading test. It is called held for trading test. So I think let me consolidate the position once again to you. So what I've given you is a 3-step model with the help of which we will be able to decide things. So it's a simple 3-step model which I've created for the ease of understanding so that you're able to reach a conclusion that the financial asset is going to be subsequently measured at AC or FPTPL or FPD-OCI. So what are you going to do in step number 1? You need to step into the shoes of the issuer. Though you are a holder, mind the words carefully. Though you are a holder, but you need to step into the shoes of the issuer. And in this particular case, you will ask yourself that if I look at the instrument from the issuer point of view, if he says FL, for me, it's a debt investment. If he says it's equity instrument, for me, it's an equity investment. If he says it's a compound financial instruments, for me, it is supposed to be, again, a debt investment. So you need to decide, is it a debt or is it an equity investment by stepping into the shoes of the issuer? That is step 1. Second, now there is going to be a 2 kind of risk test. The step number 2 is on the risk assessment. And the step number 3 is on risk intensity. The step number 2, which is risk assessment, is throwing a light on the fact that is there a risk present or not? It is checking the presence or the absence of a risk. And whether it's a debt investment or whether it's an equity investment, it's a common kind of a test which you are going to apply. And the name of the test is called a CCFC SPPI test. CCFC stands for contractual cash flow characteristic, comprising of solely the payment of principal and interest. That's called SPPI. And then there is a step number 3, which is on risk intensity, indicating the risk is high or indicating the risk is low. And there are 2 different tests for a debt equity investments. For a debt, it is called a business model test. And for equity, it is called a held for trading test, which will tell me the risk is high or low. Accordingly, I'll decide FPTPL or FPD-OCI. I guess, friends, I'm totally clear with my chain of thought so far, right? I guess I'm pretty clear on my chain of thought on my 3-step model, though we'll be working on these models now step by step. We'll look at the equity investments to begin with. Then I'm going to look at the debt investments to begin with. So the chain will get created. Trust me, by the mid of the next class, you will be absolutely clear with the logics and the basis measurement principles in various permutation combination. We will get not only the logic, but also in various permutation combinations, which measurement base would apply. Once we get the clarity of this, we'll be able to easily crack down the accounting of financial assets in the books of accounts. Okay. So I think with this inputs now, let's take this further. And I think everybody tells me pretty clear. Yes, clear. Wonderful indeed. Okay. Now, I think I'm going to first of all start the first chain with you. Let's now give you the first chain. Today, we're going to discuss equity investments with you. So hear me very carefully. Hear me very carefully in terms of things. I'm going to put across a few questions to you logically decide. I'm looking at my step number 1. I'm looking at my step number 2. I'm looking at my step number 3. I'm going to go step by step. I'm looking at step 1, step 2, and step 3. I went to the step number 1. I said, if I look at the instrument from the point of view of the issuer, I would say it's an equity instrument. So I said, okay, from the holder's point of view, what do I call this as? I said, this is going to be called as equity investments. I said, this is going to be called as equity investments. Done. My step number 1 is done. I said, okay, in step number 2, let me conduct the risk assessment. And for which I'm going to conduct the CCFC comprising SPPI test. Now let's understand what is this test all about. As a holder, I'm now asking a question to myself. Does the issuer have a contractual obligation to pay the principal and to pay the interest on that outstanding principal on this equity instrument? I repeat. I'm saying that as an issuer, does the issuer have a contractual obligation to pay the principal and the interest on that outstanding principal? I would say in terms of equity instruments, he has got no contractual obligations to pay principal. He has got no contractual obligations to pay interest. There is always an avoidable obligations. He doesn't have any unavoidable obligations to pay. So if the issuer does not have an obligation to pay the principal and the interest on the principal, now the holder is putting a test to himself, CCFC. Are my contractual cash flows, do they have the characteristic CCFC? Does my contractual cash flows have a characteristic where I'm going to get solely the payment of principal and the interest on that principal? Can I say 100% no? Can I say you will definitely fail the CCFC SPPI test 100%? Because when you're making investments in equity instruments of another company, in those particular cases, the issuer is under no obligations to pay. So there is an absence of your contractual right to receive as well. So can I say the CCFC, you have no contractual cash flows, which is comprising of principal and the payment of interest. So I think, let me ask you, if you are going to fail this particular test, let me ask you, does this mean there is no risk or there is a risk? Sir, if this test fails, it definitely indicates and implies that there is a risk. Okay. And if there is a risk, would you like to suggest me which approach, AC or a fair value? Sir, we decided when there is a risk, we're going to use a fair value. That's it. In step number 2, I'm only deciding AC or a fair value, but whether it's going to be FPTPL or FPTOCI, that depends upon the intensity. That depends upon the intensity. So I go to step number 3. The step number 3 is only indicating the presence of a risk, confirming that there is a risk and therefore a fair value approach needs to be applied. Then I go to the step number 3, and now it's an equity investment. So I need to conduct a test which is called an HF test. Now let me ask you something, friends. When I say held for trading, it means that it is held for short-term speculation gains. When you are holding a particular investment with the objective of short-term profit-making objective, Do you think it's risky kind of affairs the company is doing? If the company has made an investment and it is holding that investment for the purpose of trading, short-term profit-making objective is on the back of the mind, does that indicate that it's a very risky instrument? Yes, of course. So if you say, yes, it is held for trading, if you say, yes, it is held for trading, then I think it becomes a very risky instrument. Would you like to give me the measurement approach in this case? Would you like to give me a measurement approach in this case? And it's going to be FVTPL, because the company is taking a huge risk by making a short-term profit-making objective. So we are going to apply an FVTPL. Wow. But if you say no, it's not held for trading. If you say no, it is not held for trading in this particular case. Now let me ask you, if you say that this investment is not held for trading, does that slightly reduce the risk? Because if it is held for trading, it means it's short-term investment. And if you say it's not held for trading, does that indicate that it's a little long-term investment? Does the risk slightly go down? Yes, the risk slightly goes down. Here, the standard tells us that if the risk slightly goes down, now I'm not saying that you'll use an FPD OCI. The standard says that you have a choice. The standard says that you've got a choice that either you can use an FVTPL itself or you can use an FPD OCI. You can make a choice between the two. You can make a choice between the two. But let me now tell you that if you choose an FPD OCI, this comes with a no recycling concept. This comes with a no recycling concept. Now, I don't know how comfortable you are with the concept of recycling and no recycling. So what is your comfort zone? Are you clear with that concept? Otherwise, I'll be putting a little more light on that, but not today. I'll be throwing a little more light on this in the next class, but I think let me just get your inputs at this stage. How comfortable you are with the concept of this OCI recycling and no recycling concept. Okay, and okay, Rashmi, you said, so can you please repeat how just risk is there? Okay, I'll just put that in step number 2 once again to you. And I think Koshki tells me, so no, we don't know nothing. Okay, not a problem. We'll give you the background. So let me first answer, I think, Rashmi, to you. You know, in step number 2, we are looking at CCFC. Are the contractual cash flows which you are going to get comprising of principal and the interest or not? Now, let me, I think, say this. If there is an equity instrument, from the point of view of the issuer, does he have a contractual obligations to pay the principal and the interest? No. So as a holder, do you have the contractual rights to receive the principal and interest? No. So are your contractual cash flows as a holder, comprising of the principal and the interest on that principal? Can I say no? I don't have any contractual rights to receive the principal and the interest on that principal. So can I say a failure of the contractual right to receive the principal and the interest on that principal, does it make it a risky instrument? Agreed. Does it make it a risky instrument? Agreed. And if it becomes a risky instrument, I'm done with the step number 2, that a fair value approach would apply. If you pass this particular test, it indicates that there is no risk. Because if you've got the right to receive the principal and the right to receive the interest on that principal, then I think you're safe. Then I would say that there is no risk in that case. But the failure of this test would indicate a risk. And let me tell you, in terms of equity investments, which is an equity instrument from the issuer point of view, can I say I will never have a contractual rights in terms of getting inflows from principal and interest? Now, you would also tell me, sir, then what is the good point in terms of conducting step number 2? Can we outrightly always say in step number 2 that this will always fail for equity investments? Yes, sir. You can outrightly say that this test will definitely fail in terms of equity investments. You can directly go to the step number 3 and just look at the risk intensity. And you can see that, what is the objective of holding this investment? Is it a short-term investment? Were you going to do a trading? If it is held for trading where the short-term profit-making objective is there, indicates a huge risk, then it is FPTPL. And if you say that it is no risk, then in that particular case, you get a choice. It's not FPTPL or FPT-OCI, you get a choice between the two. But when you get a choice that FPT-OCI comes with no recycling. Now, what is that no recycling and all? We'll be discussing that later. But is this chain, I guess, absolutely clear, right? Okay. Now let's do one thing. Let's, I think, come back to the unit number 2 of the study material, and let's look at the equity investments trail. I have covered the equity investments trail in this particular case. Now you can clearly see. You can see the equity investments out here. And then you can see that we are on the box number 2, which is talking in terms of contractual cash flow, CCFC, comprising SPPI. And you can see in terms of equity investments, this will definitely fail. So that is my step number 2, CCFC comprising SPPI, and it will fail. Then you go to the step number 3, and you put across the risk intensity test held for trading. The moment you say, yes, it is held for trading, then you come to FVPL. That's fair value through P&L, FPTPL or FPL, whatever. And if you say, no, it is not held for trading, then you need to see that have you selected the FPT OCI option or not. If you've selected an FPT OCI option, you can use an OCI with no recycling, or you can take FPTPL. You got a pure choice. This is not a conditional choice. This is not a conditional choice, but it is supposed to be a free choice available to the company that they want to take the investments in equity measured at FPTPL, or are they going to take it at FPT-OCI if it is supposed to be a long-term investment which is not held for trading. I guess, friends, I am pretty clear with the chain of thought, right? Clear, Rashmi? Okay, wonderful indeed. Okay, I didn't get much inputs on the concept, whether you're comfortable with the concept of OCI-R or OCI-NR. Accordingly, I need to make my thought processes that do I give you a little more depth on that in the next session or not. So if you could give me some inputs on what is your comfort zone on OCI-R and OCI-NR, accordingly, I will tackle that issue, at the beginning of the next session itself, so that you get a good hang in terms of financial instruments. Because I need to connect you in terms of OCI, SOKI, and the financial instruments so that we can get a very good understanding on this. Okay, so do let me know your inputs. I think in the absence, I will presume you know it. And if you say, then I'll get the information. So silence will be taken as a deemed acceptance for things. Okay, so far so good on this. My equity part is done. I'm not picking up the debt part right now. But I think before that, what I want to do, I just want to take a little quick recap on the learnings today and then give you some MCQ questions as well. So I think let's begin the journey, first of all, with that. And I think, yes, Manini says we are clear, and Sai Venkat tells me we're clear. Okay, then it's great. Then I think I need not spend time on that. Okay, so now, first of all, let's take a quick recap. But before that, let's give you some MCQ questions to you. Let's give you some MCQ questions to try. You can try answering them, but I'll give you the answers in the next class, not today. So let me begin with my 5 MCQs to you. Number 1, I'm looking at all financial assets and financial liabilities are initially measured at fair value. Are measured at fair value. So very clearly, I am telling you that all the financial assets and all the financial liabilities are initially measured at a fair value. So you need to decide true or false. That's one. Second, the second one is that financial assets, brackets, I'm putting it as equity investments. Financial assets, brackets, I'm saying equity investments are measured at are measured at fair value always. Are measured at fair value always. I make a very strong kind of statement that if you've got financial assets, equity investments, they're measured at fair value always. Number 3, I'm not talking of debt investment, so I cannot talk on that. Then the third one is amortized cost approach. Amortized cost approach ignores changes in fair value. Changes in fair value. The amortized cost approach ignores the changes in fair value. So we do not incorporate the changes in fair value for an amortized cost approach. Number 4. And I guess let's put the number 4 as if equity investments are held for trading. If equity investments are held for trading, they are always measured at FVTPL. They are always measured at FVTPL. So if you got equity investments which are held for trading, they're always taken at a fair value through PL. This time you got some very interesting, easy questions. And number 5. And we're looking at number 5, where we can say if a financial asset is measured, at FPTOCI, if a financial asset is measured at FPTOCI, fair value changes does not impact EPS of current year. So we can say if a financial asset is measured at FPTOCI, the fair value changes does not impact the earning per share of the current year. So I think these are the 5 MCQs for today's learning. Now I think let's take a quick recap in terms of things. I'm pretty sure I would have already got things from you. And Kaushiki tells me, so I never heard of before recycling, no recycling. Okay, not an issue. I think I'll give you the inputs in any case. It'll be a revision for those who know it. And I think it's going to be a learning for those who don't know it. So no worries. I think we'll take care of the interest of everybody into account. Okay, now I think let's take it further. Before we end for the day, let's look at a little quick mind map with you in terms of what we have learned today. Well, I think the first thing what I gave you today was in terms of the special issue relating to compound financial instruments. I think that doesn't need much mind mapping. I think there are only 2-3 important agendas which I gave you for the day. 2 most important learnings for the day is number 1. I gave you a total of 3 things which you need to keep in mind. I gave you number 1. The first thing what you need to consider is that we don't apply the historical cost approach, but we apply an amortized cost approach. What is the difference between the HC and the AC? That we have switched over from a contracted rate to the concept of an effective interest rate accounting. We don't want to consider the negotiated deal as the base, but we want to look at the substance of the transaction, that is EIR. Second, we introduced the concept of fair value change, and this is to incorporate this as a part of the return. We wanted to capture this as a part of the return because the fair value increase is also supposed to be a positive return and a decrease is a negative return. So we introduced a fair value change concept. And the measurement base is completely based on a risk assessment. The moment you say there is no risk, we're going to use a cost approach, the new version called amortized cost approach. The moment you say, yes, there is a risk, we need to apply a fair value approach. And within that, I also gave you that if you say that the risk is high, then I would use an FVTPL approach. And if you say the risk is not that high, then in that particular case, an FPTOCI approach. So the risk is the base. And for the purposes of risk, we've already seen that there are going to be certain tests which I've already given you. One is a CCFC comprising SPPI test, and the other is the business model and the HFT test. So risk becomes the base of deciding the measurement base. And the second thing which I've given you is in terms of the three-step model which I gave you. I said, if you're looking at the financial assets to be measured subsequently, you got to apply a three-step model. And in terms of the three-step model, what do you need to do? You need to first of all step into the shoes of the issuer and decide the category. His FL, my debt investment. His CFI, my debt investment. His equity instruments, my equity investments. Step into the shoes of the issuer and decide whether it's a debt or an equity investments. The second is conducting the risk assessment test, identifying whether risk is there or not, which is a common test for debt equity, and that is what we call the CCFC comprising SPPI test. The third is looking at the intensity of the risk, and that is what we call technically that there are going to be two different tests, different for a debt. For a debt, we've got a business model test, and for an equity, we've got what we call the HFT test. So common test in terms of step number 2 for debt equity, but it's a different test altogether. And we made a run through in terms of equity investments, and we said it'll definitely fail the step number 2. And if it is held for trading, then it is FPTPL. And if it is not held for trading, you get a choice in terms of FPTPL or in terms of FPTOCI. Well, I think that makes us the crux of the things today. I know the session today would have been slightly technical, but I think we've learned a lot of important logics today in terms of financial instruments. So do revise all this bit. We'll take the journey forward with you in the next class on this. First, I'll be answering the questions, what I have given you the MCQs. I'll give you a little concept in terms of the OCI NR concept as well. So for those who are not aware of this concept well, are able to catch up this in terms of financial instruments. Right, so let's see if there is any questions coming at your end. Okay, I think, Soham, you said, so every time an entity invests in a financial assets, they will have to ask the investee what treatment they've given in the books. Well, it's not asking the investee, friends. Let me, I think, clarify. I'm saying that you need to step into the shoes of the issuer. You don't need to go and give a issuer on that case, right? You don't need to go to the issuer and ask him that, boss, what is the status? You need to step into the shoes of the issuer and see that if I were the issuer, how would I, classify the instrument as? So you need to see the same instrument from the issuer point of view and then decide it's a debt equity investments, not literally going to the issuer and asking him what does he show it in the balance sheet, right? Okay, Rashmi, understood, sir, so far, but no idea on recycling. Okay, not an issue. And okay, I think another question with Kaushiki you got, if it is held for short term, the changes won't be much, so less risk. No, if it is short term in nature, the changes can be massive as well. If you, let's say you're doing intra trading in terms of the shares, then intra trading would mean that the market would fluctuate very high. There could be a prices, which may drop suddenly in the next 2 days. So we can't say that if it is short term, the changes won't be much. There can be massive changes as well, right? Okay, got it, Shoham. Okay, wonderful indeed. I guess, Kaushiki, you also got your answer on that. So I think on that particular note, I think it's time to bid goodbye to all of you, friends. And I'm going to see you in the next class. So thank you very much. Bye-bye and take care, all of you.